All right. So, guys, welcome to the Sherpa System. Um, let's go. So, in this system, guys, there's a few different concepts and modules that we'll go over. Like I said, we're doing this 5 days in a row, starting at 9 o'clock every day this week, okay? So some of the modules or the module we'll be covering is the introduction, which is going to cover a lot of knowledge about the industry itself, all right? Then we're going to get into the psychology behind trading tomorrow. Wednesday is going to be risk management and how to manage it. And then we'll actually set up the actual Sherpa template. And then Thursday, we get into fundamental analysis. And then Friday, we get into the technical analysis and the Sherpa War 3 strategy, okay? So Thursday and Friday are the fun days, guys. I would say that. So your prerequisites for this course, guys. Of course, you want to have a broker. I use Owanda, which is a FTC regulated, and KLT Forex. That's non-regulated. But so use that at your own risk. And you want to open your practice account, guys, using an initial trade amount that's relative to what you realistically would deposit into your live account. This is something that I just mentioned before starting the class, actually. For you guys to get the full feel or the real feel of trading in the demo environment, guys, you have to use an amount that's close to or the exact amount that you're going to open your first live account with. The reason is because it's a huge difference trading with 5,000 in demo, and then you just deposit 1,000 into your live account. It's a huge difference. You're going to guarantee to blow your account that way. The software that I use, guys, is of course MetaTrader 4 app. Only reason why I use MetaTrader 4 the app on my phone is because I use a MacBook. And as you all know, trying to get MetaTrader 4 to run on a MacBook is like scratching your nail against a chalkboard. It's hard and it's terrible. It's excruciating. And then I use TradingView, guys, for my chart markups. I do want to notate that there will be occasional disparities in some instances due to the difference in the liquidity providers between your broker that you're using and the TradingView software. I'm not too sure if you guys are familiar with TradingView, but if you guys like look for, let's say, Euro USD, it'll pull up Euro USD, but it will have like FXCM or Wanda, just different brokers, because different brokers, they use different data feeds, and that's why. There's also a TradingView mobile app. And then, of course, the last prerequisite, guys, is allow yourself time to unlearn anything that you may have learned. And then, of course, patience to learn this system. I don't claim that this is a holy grail system, guys. I never have, but I will say that it will keep your win to loss ratio quite high if you just follow the blueprint. And then, of course, with this course, guys, we're going to help keep things in perspective, right? We're not going to be too outrageous with it, but just understand the power of the industry. So what's Forex, right? Start where you are, use what you have, do what you can. That's a famous quote by Arthur Ashe. How I relate this to Forex, guys, is this is a fresh new journey for most of you guys, right? Some of you guys may not have the capital. Some of you guys may not have the mindset. Some of you guys may not have the right environment, or some of you guys may feel like you don't have all that stuff, right? But understand that, guys, none of that really matters if you're determined. Okay, so you have to start with what you have, and start with where you are, and then just slowly do what you can, right, and build upon that. So what is Forex, guys? Now, it's a big misconception, guys, that Forex is a company or pyramid scheme or a scam. Boy, are you mistaken. Forex is actually an industry, okay, that you trade within 5 days a week, 24 hours a day, opening at 5 p.m. on Sundays, closing at 5 p.m. on Fridays. All right, guys. Retail traders, you and I, banks, governments, investors, businesses, they all speculate, guys, and exchange currencies that are available through online brokers. That's how we trade. We use a combination of fundamental analysis and technical analysis to predict probabilities of a currency's next move, whether it's up, down, or if it's going to consolidate. Again, You can't join this, bruh. This ain't no company, man. This is an industry, guys. This is a financial market. All right. So anybody out there saying join Forex, smack them on the head, call them a fool, because you don't join Forex, you trade within it. Look at this. Ain't nobody got time for that. So what's the whole process, right? When you guys enter a trade, all right? So here's what happens when you guys, market execute. We use, as a trader, guys, we use an electronic trading platform. Usually it's MetaTrader 4. That's the electronic trading platform that you get from your broker to execute a trade. Now, depending on what type of broker you're using, guys, this is big, okay? You're either going to choose between a dealing desk broker or a STP, or a straight through process, or an electronic communications network type of broker, okay? And the difference between those two determines how your trade basically interacts with the other party. So for fair warning, guys, you never really want to try to trade with a dealing desk type of broker. The reason is because dealing desk brokers, they take the opposite position from you. So if you're buying, guess what? They're selling that to you. If you're selling, guess what? They're buying that from you. Dealing desk brokers don't really have your best interest at heart because they make money off of you losing, okay? But if you do so happen to win with a dealing desk broker, guess what they do? Then they connect you to the interbank network. Versus if you just trade with a ECN platform or a straight through process, guys, you're getting connected straight to the interbank market, which means when you sell, that broker is having to find somebody else outside that network or that broker to basically buy that from you. All right. So they don't make money off you losing. They want you to have longevity in trading, because these are the brokers that's going to make the money from like your swap fees. These are the brokers that may make the money off of like your spread of the pips and things of the sort like that.
Can I ask a question?
Yes.
I use Hugo's Way. Is Hugo's Way is that a bad broker? Is that a dealing desk?
No.
Oh,
good. You're good.
Okay, cool. Thank you.
Oh, no problem.
Yeah, it was good, family.
What's happening?
What's
up, Mr. Jackson?
What's going on?
Oh man, nothing, bro. Just chirping around, bro.
Oh yeah. I see Antoine Gary on here. That my boy?
Antoine Fuchs, but hold on real quick.
I'm here.
What's going on, brother?
What's up, bro?
Not much.
Hold on.
We got 125 people up in here. Okay.
Yeah, man.
Let me let you conduct.
A lot of people are going to be on day 3, 4, 5. So
okay. Oh yeah, you're right.
I told them they could skip 1 to 3. So if they already took it, but let's continue. All right. Again, guys, I want to stress that you guys don't really need to join a company to trade Forex. Why? Because you don't join Forex. It's the financial market within we trade. Okay. So what's traded within the Forex industry, right? There's multiple ways to trade currencies, guys. All right. Forex, though, is just a general name for currency trading. It's important to point out that we are covering the different ways that individual traders can trade Forex. All right. Now, I'm not going to get into Forex swaps or forwards because those cater to the institutional traders. We're not institutional traders. We are retail traders. All right. So we'll cover things like the options, ETFs, and the futures and spot Forex, basically. So currency futures. These are futures, right? It's a hedge against a future profit or loss, guys. Okay. So future contracts. Futures are contracts to buy or sell a certain asset at a specified price on a future date. That's why it's called futures. A currency future, though, is a contract that details the price at which the currency could be bought or sold and sets a specific date for the exchange. Currency futures were created by the CME, or the Chicago Mercantile Exchange, way back in 1972 when bell bottoms and platform boots were in style, a long time ago. Since future contracts were standardized and traded on the central exchange market, the market is very transparent and it's very well regulated. So this means that price and transaction information are readily available. Now, the rate, though, for currency futures though it's actually derived from spot rates of the currency pair. That's where we come in at. Currency futures, they are used to hedge against the risk of receiving payments in a foreign currency. So you're probably like, what's going on? What do you mean? I got an example for you guys. So let's assume that hypothetical company XYZ, which is based here in the United States, let's say it's heavily exposed to the foreign exchange market, to foreign exchange risk, and wishes to hedge against its projected receipt of 125 euros in September. Prior to September, though, the company could sell those future contracts on the euros that they will be receiving. So the Euro FX futures will have a contract unit of 125,000 euros. So when they sell those futures, those Euro futures, because they are a United States company and we don't need the euros, we need dollars. Therefore, since they know they will receive euros, they can sell them now and lock in a rate at which those euros can be exchanged for dollars. So if they're, let's say they're going to receive 125 million euros in September, right? September of 2021, and they know that. Let's say prices trading pretty high for the euro, and it's expected to go down. So instead of holding on to those 125 million euros, what they'll do, guys, is they will sell those off at an early date. Let's say they sell them here in December, right? They're selling those 125 million euros, let's say at $1.25. Come September, a euro will be only worth, let's say, $1.05. So since they sold here in December at $1.25, they're still making profit and collecting more and collecting that 125 million euros. Now, the exact opposite of that, though, let's say if they believed, you know, the euro was going to be $1.05 come September and it's $1.25 right now, and they short sold the euro, but instead of it going down to $1.05, it rose. Guess what? They're losing out on that profit now. That's how the futures work. Company XYZ sells 1,000 future contracts on the euro to hedge its projected receipt. Consequently, if the euro depreciates against the dollar, the company's projected receipt is protected. They locked in their rate, so they get to sell the euros at the rate they locked in. However, the company's forfeits any benefits that were clear if the euro appreciates, guys. They will still be forced to sell the euros, but it's going to be at the price of the future contracts, which means giving up the gain relative to the price in August that would have they would have had if they had not sold their contracts. A currency option. This is getting into like binary options, which is, I guess, kind of starting to make a comeback, guys. Binary options is actually where I first started or got introduced into the Forex industry. It's pretty crazy. An option is a financial instrument that gives the buyer the right or the option, but not the obligation to buy or sell an asset at a specified price on the option's expiration date. If a trader sold an option, then he or she would be obliged to buy or sell an asset at a specified price at the expiration date. So just like futures, options are traded on an exchange, such as the CME, the International Security, or the Philadelphia Stock Exchange. However, the disadvantage, though, to trading Forex options is that the market hours are limited for certain options, and that liquidity is not nearly as great as the futures or the spot market. So trading binary options isn't necessarily bad. It has its limitations in regards, like it says, you know, trading in the futures or the spot market, basically. So what is a currency ETF? An ETF stands for exchange traded funds. An ETF offers exposure to a single currency or a basket of currencies, all right? The currency ETFs allow ordinary individuals to gain exposure to the Forex market through a managed fund without the burdens of placing individual trades. This is when you get into like account management, corporations and things like that, private hedge funds and things of the sort. They trade traded funds, exchange traded funds, basically. Currency ETFs can be used to speculate on Forex or diversify a portfolio or hedge against currency risk. ETFs are created and managed by financial institutions that buy or hold currencies in a fund. Then they offer shares of the fund to the public on an exchange, allowing you to buy and trade these shares just like stocks. Like currency options, the limitation in currency trading ETFs is that the market also isn't open 24 hours. And ETFs are subject to trading commissions and other transaction costs. Spot Forex, or the spot FX market, okay? The spot FX market is an off-exchange market. It's also known as an over-the-counter market. The off-exchange market is a large, growing, and very liquid financial market, guys. It operates 24 hours a day, almost 7 days a week, pretty much. It's not a market in the traditional sense because there's no central trading location or exchange. In the OTC market, or over-the-counter market, a customer trades directly with the counterparty. This is the spot FX is beginning to get into where us retailers come into. We're not there just yet, all right? Unlike currency futures, ETFs, and most currency options, which are traded through centralized markets, the spot FX are over-the-counter contracts or private agreements between two parties, basically. Most of the trading is conducted through MetaTrader 4 or an electronic trading network, right? The primary market for FX is the inter-dealer market. That's where the Forex dealers trade with each other. A dealer is a financial intermediary that stands ready to buy or sell currencies at any time with his clients. That's what your broker's doing, guys. It's using software to interact with other people, other brokers, other inter-dealer markets, and execute that trade for you. It's all electronic. The inter-dealer market is also known as the interbank market due to the dominance of banks as the Forex market dealers. The inter-dealer market also is only accessible to institutions that trade large quantities and have a very high net worth. This is going to include your banks, your insurance companies, pension funds, large corporations, and other large financial institutions that manage risk associated with the fluctuations in currency rates. So anybody who has, well, I'm not gonna say anybody, almost anybody who has like a 401k through like their company, a pension fund through a company, anybody that's invested in some way through like a company generated type of financial system, guys, they're trading in the spot FX market. So you can almost, I think there's a bank actually, I forget, somebody was telling me about it, where they let you control your whole 401k by yourself. If you know how to manage it, then deposit it and start trading. I forget who it is. Once I get it, I'll let you guys know. It's pretty dope. In the spot Forex market, an institutional trader is buying and selling an agreement or contract to make or take delivery of a currency. A spot FX transaction is bilateral, meaning between two parties, and it's agreement to physically exchange one currency against another. This agreement is a contract, which means that this spot contract is a binding obligation to buy or sell a certain amount of foreign currency at a price, which is the spot exchange rate or the currency exchange rate. So if you buy your Euro USD on the spot market, guys, you are trading a contract that basically specifies that you will receive a specific amount of euros in exchange for the United States dollars at an agreed upon price. That agreed upon price, that's called the exchange rate. It's important to point out that you are not trading the underlying currencies themselves, but a contract involving the underlying currencies. So even though it's called spot, the transactions, guys, they aren't exactly settled on the spot. They are actually settled what is called T+2. T+2 is known as today plus 2 business days. It means that delivery of what you buy or sell should be done within 2 working days and is referred to as the value date or the delivery date. For example, an institution buys Euro USD in the spot Forex market. The trade open and close on a Monday has a value date on Wednesday. This means that they'll receive euros on Wednesday. But not all the currencies, guys, or not all the trade instruments are T+2. Some of them are T+1, meaning today plus 1 business day, like US CAD. US Ruby, things like that. Trading in the actual spot Forex market, though, is not where us as retail traders reside. Now, let's get into our realm, right? The retail Forex. It's for us poorer traders, right? This is the secondary over-the-counter market that basically provides a way for us retail traders to participate in the Forex industry. Access is granted by so-called Forex trading providers or brokers. Now, I do want to differentiate or point out though, guys, that Forex trading providers trade in the primary over-the-counter market on our behalf. They find the best available prices and then add a little bit of a markup, which is normal. It's like going to a store, right? Before displaying the prices on their trading platforms. Now, like I said, this is very similar to how retail stores buy inventory from a wholesale market, add their own markup to it, and then show a retail price to our customers or to their customers, right? Now, getting into the Forex trading providers, technically they're not really brokers because a broker, right, is supposed to simply act as the middleman between the buyer and seller, okay? But that's not the case, guys, in most trading, because a Forex trading provider acts as your counterparty when you're dealing with a dealer desk sometimes, right? So this means that you are the buyer and it acts as the seller. And if you are the seller, it acts as the buyer. But for the training purposes, guys, we'll call them all brokers. It's just important to know the difference. Although a spot Forex contract normally requires delivery of currency within days, in practice, nobody actually takes physical delivery of any currency. The position is actually rolled forward to the delivery date, especially in the retail Forex market. Remember, you are actually trading a contract to deliver the underlying currency rather than the currency itself. It's not just a contract, it's a leverage contract. So retail Forex traders can't take or make delivery on leverage spot contracts. The leverage is what allows us to control the large amounts of currency for a very small amount. And we'll cover leverage, margin, and lot size later down the road. So let's talk about this retail for a second, guys. Let's get some examples out here so that way you all understand. Retail Forex brokers, guys, they let you trade with leverage. All right. The leverage is why we can open positions that are valued at 50 times the amount of our initial required margin. Okay. Now, so what that means is, to break it down, is with $2,000 with the proper leverage, you can open a Euro USD trade that's valued at $100,000. So imagine if you went short on the euro and you had to deliver $100,000 worth of euros, right? It's crazy. Like nobody would ever take that money to the person like, here, man, you lost. I mean, here, you man, you beat me, you won, right? Nobody's gonna do that. You would be unable to settle the contract in cash since you would only have $2,000 in your account. You wouldn't have enough funds to cover the transaction, basically. And that's where leverage and margin comes in handy. So you either have to close the trade before it settles or roll it over. To avoid this hassle of physical delivery, though, retail Forex brokers automatically roll their clients' positions. When a spot Forex transaction is not physically delivered, but just indefinitely rolled forward until the trade is closed, it's known as a rolling spot Forex transaction or a rolling spot Forex contract. It's important to note that in the United States, the CFTC calls it a retail Forex transaction. I want to touch on that for a second, guys. There is absolutely no difference between a rolling spot contract or a rolling spot Forex transaction and a retail Forex transaction. There's absolutely no difference. The wording is different because of the regulation behind a US trader. That's it. This is how you avoid being forced to accept or deliver 100,000 euros. Retail Forex transactions are closed out by entering into an equal but opposite transaction with your broker. So what that line says is, if you sold, you close out that trade by buying. You just hit close, really, but they bought. For example, if you bought British pounds with the United States dollars, you would close out the trade by selling those pounds for United States dollars. That means it's going to exchange back into your, I would say, your home or your base currency. This is also called offsetting or liquidating a transaction. If you have a position left open at the close of a business day, it will automatically be rolled over to the next value date to avoid delivery of the currency. And you'll get hit with what is called a swap fee or a rollover fee. And then this is something that your broker automatically does and will keep on doing it until either you get hit with a margin call or you close the trade itself, okay? The next procedure for rolling currency pairs over is known as tomorrow next or Tom next, which is tomorrow and the next day. When positions are rolled over, this results in either interest being paid or earned by the trader. Yes, guys, brokers can pay you on your swap fee if you're trading the right instrument, and it's based on interest rates. Your broker will calculate the fee for you and will either debit or credit your account balance. Retail forex trading is considered speculative. This means traders are trying to speculate or make bets on and profit from the movement of exchange rates. They're not really looking to take physical possession, guys, of the currency rates of the currencies that they're buying or selling. Now, a forex spread bet. We're getting into some really good base knowledge here, guys, that you guys probably haven't heard of before. Some of you probably have. Like I said, I want to take you guys from the beginning all the way through. Spread betting is a derivative product, which means you don't take ownership of the underlying asset, but speculate on whichever direction you think its price will move, whether it's up or down. This is where we kind of mainly reside. A forex spread bet enables you to speculate on the future price direction of a currency pair. A currency pair's price being used on the spread bet is derived from the currency pair's price on the spot forex market. Remember that spot market we said that all the heavy hitters play in? That's where the forex spread bet is derived from, basically. Your profit or loss is dictated by how far the market moves in your favor before you close your position and how much money you have bet per point or per pip price movement. Spread betting on Forex is provided by spread betting providers, Hugo's Way, KLT Forex, your broker, right? Unfortunately, though, if you live in the United States, spread betting is considered illegal. Despite being regulated by the FSA in UK, the US considers spread betting to be internet gambling, which is currently forbidden. Guys, that's haberdashery. It all comes down to wording, all right? And you'll hear why. Forex CFD, contract for difference. A contract for difference is a financial derivative. Again, it's derivative product tracks the market price of an underlying asset so that traders can speculate on whether the price will rise or fall. The price of a CFD is derived from the underlying asset's price. I would say a CFD. So I'm gonna pause right there before I go because I want to touch on something. So a CFD, guys, I would say would be, you know how people are trading US 30 right now. I would say that would be a CFD. The reason why I'm saying that's a CFD is because if you guys know, without the right capital, more times than not, guys, United States customers can't really trade futures without the proper broker. Now, Hugo's Way, KLT Forex, those are offshore brokers that are offering contracts for difference or CFDs on those futures, which allows us to trade it. All right. I just wanted to touch on that so that way you guys knew the difference between a CFD and like an actual future. They're very different, actually. A CFD is a contract typically between a CFD provider and a trader, where one party agrees to pay the other difference in the value of a security between the opening and closing of the trade. In other words, a CFD is basically a bet on a particular asset going up or down in value with the CFD provider, and you agree that whoever wins the bet will pay the other the difference between the asset's price when you enter the trade and its price when you exit the trade. A Forex CFD is an agreement or a contract to exchange the difference in the price of a currency pair from when you opened it and versus when you closed it. And it's counted by points usually, guys. We count US 30 by points. So when people say it moved like, 200 pips, no, it moved 200 points. And the reason why it's kind of about a point is smaller than a pip, I would say. Because remember, a pip is a point in percent. So that point is less than a pip. Now, a currency pair's, or at least it should be. Yeah, a currency pair's CFD price is derived from the currency pair's prices on the spot Forex market, or at least it should be. And if it's not, guys, what is the CFD provider basing its price on? So you got to kind of watch out for this, some stuff, guys. And a lot of the stuff that I'm getting into, guys, it's just basic knowledge. It's nothing that's probably going to stick with you guys, but it's good knowledge and information to have, because you have to honestly kind of watch out for some of these brokers. Like if you're, trying out new brokers and things like that, and if you are trading, let's say like a US 30 and you don't know some of this information, you can get got, guys. Like it's like that out there. Trading Forex CFDs give you the opportunity to trade a currency pair in both directions as well. You can take both long and short positions. With offshore brokers, you can do that as well. With CTFC regulated brokers, we're not allowed to hedge. We are bound by the first in, first out rule. So what that means is, let's say if we entered a sell on Euro USD and we stack those trades, right? We stack 5 trades on Euro USD. We can't close that first trade until we close those other 4. It kind of sucks. If the price moves in your chosen direction, you would make a profit. If it moves against you, you would make a loss. And the Euro and the UK regulators decided that rolling spot FX contracts are different from traditional spot FX contracts. The main reason being is that the rolling spot FX contracts, there's no intention to ever take physical delivery or ownership of that currency. Its purpose is to simply speculate on the price movement in the underlying currency. The objective of trading a rolling spot Forex contract is to gain exposure to the price fluctuations related to the underlying currency pair without actually owning it. So to make the differentiation clear, a rolling spot Forex contract is ruled as a CFD. In the United States, though, CFDs are illegal, and so it's known as a retail Forex trading transaction. It's the same thing, guys. It all comes down to wording. I kid you not. Forex CFD trading is provided by CFD providers outside the US. Retail Forex trading is usually done with CFDs or spread bets. Now, how do we make money while we're trading? Okay, this is a good topic right here, because I'm going to get into some different calculations on how to calculate the value of a pip. Because again, guys, you can't put a blanket statement of saying one standard is equal to $10 a pip for every currency pair. You're going to mess up your risk management, and you're just going to mess up your risk management. So I want to give it to you all the way. All right. So let's start with another quote. Instead of worrying about what you cannot control, shift your energy to what you can create. That's Roy T. Bennett, The Light in the Heart. So how do I relate this to Forex, guys? Right. You have to understand that nothing is 100% in Forex, guys. And no matter what strategy, indicator, or anything like that, who you're following, guys, we don't control the markets at all. We don't have the equity, the volume, the liquidity to control the market or even to manipulate it. So we can't control it. So don't get mad when, let's say, your stop loss gets hit. Don't get mad when a trade doesn't go in your favor. It's bound to happen. Instead, shift that energy into why and create a new opportunity for you to build upon off of that, right? That's how I relate this to Forex. So how do we make money, guys? It's bag season. Placing a trade in the foreign exchange market is simple. Trading is simple. The hard part is the psychology behind it. The mechanics of a trade are very similar to those found in other financial markets. The objective in a Forex trading is to exchange one currency for another, an expectation that the price will change. So here's the example that we use, guys. In this chart, we've got the trader's action, and we're speculating on the Euro USD. So we're purchasing 10,000 euros at the exchange rate of $1.18. All right. 2 weeks later, you exchange those 10,000 euros back into the dollar at the exchange rate of 125. To restate that same sentence, 2 weeks later, you close your order at the exchange rate of $1.25. You earn a profit of $700 off of that trade. Now, that's a swing trade and may not even take 2 weeks to even get there. But hey, we're dealing with the euro, it might, right? So here's the math behind that, guys. So 1 euro, which is 10,000 euros times the exchange rate of $1.18, that equals 11,800 United States dollars. All right. So if we close at $1.25, we take those same 10,000 euros, multiply that by the $1.25, and we get 12,500. The difference between that, guys, is your profit. An exchange rate is simply the ratio of one currency. What's up, Brian? An exchange rate is simply the ratio of one currency valued against another currency. For example, the Euro Swiss franc exchange rate indicates how many United States dollars can purchase one Swiss franc, and how many Swiss francs you need to buy $1, basically. So how do we read these quotes? Now, guys, currencies are always quoted in pairs, such as British pound, United States dollar, United States dollar, Japanese yen. They're quoted in pairs, right? The reason why they're quoted in pairs is that in every foreign exchange transaction, you are simultaneously buying one currency and selling another. So in the example to the right, the British pound, United States dollar, you are, for what that's telling you is that for one British pound, it's going to cost you $1.21. That's what that quote is telling you. So whenever you have an open position in Forex trading, you are exchanging one currency for another. Currencies are quoted in relationship to other currencies. Here's an example of how a Forex rate for the British pound versus the dollar. The currency to the left, that's called your base. The British pound in this example is the base currency. Okay, the base currency is the reference element for the exchange rate of the currency pair. It always, guys, the base currency always has a value of 1. The second listed currency, or the currency on the right, which in this example is the United States dollar, that's called your counter currency or your quote currency. So when you're buying, the exchange rate tells you how much you have to pay in units of the quote currency to get 1 unit of the base currency. Like I said, in this example, it takes $1.21 to get 1 British pound. But if you wanted to sell a British pound in exchange for the United States dollar, you're going to get $1.21. The bid, ask, and spread. So this is where people, you're going to go long and you're going to go short. That's what bid and ask is telling you: short, long, buy, sell, things like that, right? All Forex quotes are quoted with 2 prices, the bid and the ask. In general, the bid is usually lower than the ask price. The bid is the price at which your broker is willing to buy a base currency in exchange for the quote currency. This means that the bid is the best available price at which you or us as the trader can sell to the market. I like to say, to help differentiate between a bid and ask, I like to say, think of an auction. If you're selling something at an auction, you have an ask price, right? You're asking a certain amount for this, let's say, for this car at the auction. The people who are coming to buy the car, they're putting in bids for that car, right, at a certain price. That's how you can differentiate between the bid and the ask. The difference, though, between the bid and the ask prices, if you were to subtract the bid from the ask, guys, that's going to give you your spread. The spread is how our non-dealing desk brokers usually get paid. They got to make some money somehow, right? And since they get paid by the spread, guess what they want you to do? They want you guys to win. They want you guys to continue trading with them because that's how they're making their money, right? So they're more times in your favor than against you. On this quote up here, though, guys, on the Euro USD quote, the bid price is $1.34, 568 pips. The ask price is $1.34, 588 pips. If you want to sell the euro, you're going to hit the sell button, and you're going to sell the euros at the price of $1.34, 568 pips, and you're going to buy it at $1.34 and 588 pips. Now, lots and margin. Guys, I highly recommend you guys hone in on these next couple of slides as we deal with lots, margin, and leverage, because I still feel there may be a lot of confusion as far as understanding the difference and the difference between the three, but how they all correlate with each other. It's kind of a weird little relationship between the three. But I'm gonna do my best to try to explain it for you guys, okay? So starting out, guys, understand that we are margin trading, okay? So when we go to the grocery store and we want to buy an egg, we can't just buy a single egg. That would be considered goofy. They come in dozens or lots of 12, all right? So just like you have to buy a dozen or a lot of 12 eggs in Forex, it would be just as foolish to buy or sell one single euro. So they come in lots of 1,000 units of currency, or they come in lots of 10,000 units of currency, or 100,000 units of currency. The difference, the units of currency are determined by your lot size. So you've got a micro lot of 0.01. That's you taking control or moving around 1,000 units of the currency. If you do 0.10, now you're moving around 10,000 units of the currency. If you do a full standard, you're going to still move around 100,000 units of that currency. All right. And that's dealing with lot sizes. So if you do two standards, right, now you're at 200,000 units of the currency. If you do 0.05, you're at 5,000 units of the currency. And it goes on like that pretty much, okay? Now, you don't have to have all that money to be able to trade, okay? You don't have to have $10,000, $12,000 to be able to trade. This is where leverage comes in at, guys, okay? We're able to move those hefty amounts of those hefty units of currency because of leverage. So when you trade with leverage, there's no need to pay those 10,000 euros up front. Instead, what happens is you put down that small deposit. That small deposit is that margin. All right. So let me break it down. The lot sizes are controlling how many units of a currency that you're moving. The leverage is so that way you don't have to pay the full amount of those units up front. The margin is the deposit you put down to place the trade. So hopefully that clears it up for you guys a little bit better, right? Leverage is the ratio of the transaction size or the position size to the actual cash or the trading capital used for margin. So for example, we've got 50-to-1 leverage. 50-to-1 leverage is usually the max of most United States regulated brokers. It's terrible, guys. 50-to-1. Now, it's terrible, but at the same time, it does prevent you from over leveraging. 50-to-1 leverage is also known as a 2% margin requirement. That means $2,000 of margin is required to open a position worth 100,000 units. So using 50-to-1 leverage, if you're using a United States regulated broker like Owanda, in order for you to place a standard, you have to have a minimum of $2,000 in your trade account. And probably, well, actually, you're going to have a minimum, I would say, honestly, 3, because even if you had 2,000, they probably still won't let you because you may get margin call shortly after that. Margin trading, though, lets you open large positions sizes using only a fraction of the capital that you normally need. This is how we're able to open $1,250 or $50,000 position, guys, with $500 accounts, $25 accounts, or $1,000 accounts, right? Because of the leverage that we're using. A lot of us are probably using 500-to-1. That's a huge difference from 50-to-1. So you're basically multiplying your initial capital by 500. So, did I skip something? No, I didn't. Okay, cool. So let me explain again, lot sizes and leverage, right? Let's say you believe that the signals in the market are indicating that the British pound will go up against the dollar. So you open one standard, or you buy 100,000 units of the British pound with a 2% margin requirement. So you're using 50-to-1 leverage. You wait for the exchange rate to climb. And when you buy one lot of the British pound at the price of $1.50, you're buying 100,000 pounds, right? That's what you're controlling. Remember, one standard is equal to 100,000 units. Okay. Now, because you're buying at the exchange rate of $1.50, you now have to multiply those 100,000 pounds by that $1.50. So all in all, you control a value of $150,000. Since the margin requirement is 2%, 2% of that $150,000, guys, is $3,000. That's the margin that the broker would pull from your account balance in order to open up that trade. So now you control 100,000 pounds, guys, with just $3,000. And if your predictions come true and you close your order at $1.50, 500 pips, you just earned about $500 because it only moved 50 pips. Yeah, I'm sorry. $1.50, 50 pips. Yeah, you're going to get about 500 bucks. Now, on the flip side though, guys, you could have also lost that 500 bucks being on the wrong side of the trade. And that's why we say leverage is a double-edged sword. All right. So before I go into the Forex terminology, I want to see if there's any questions that may need answered just yet. And if there are, you can unmute yourself and before we continue. So are there any questions just yet, guys?
Will the slides be available for further content later, for further review later?
Yeah, I actually was debating on releasing the slides. I think I probably will release them to you guys. Because the reason why I was debating, because I'm making a kind of like a cheat sheet, which basically breaks everything down for you guys, so that way you can print it out or have it in slide presentation formation. But if you want the whole presentation, yeah, I'm more than willing to give it to you, bro. Cool. Any other questions?
Do we need to ask for it or, separately, or you going to post it somewhere?
I mean, I'm gonna just post it. I will probably just post it in the group. But if you don't get it, DM. DM.
You can't even keep a straight face, my guy.
I know, man. I know. I got a tip.
Oh, good. Wait, we'll handle it. Yeah, we'll get it to you guys, especially you, Antoine Gary, my boy. I know Brandy happy. I know Brandy happy to see you around.
All right.
No doubt. And so guys, we've got about.
I actually had a question for you, my guy.
Okay.
So you didn't get to the 3 screen yet, right?
No, this is just the like laying some terminology foundations and stuff.
Yeah. Okay. Yeah, that's right.
Number 1, man.
Yeah.
That's
Never bet on them.
So what I'm going to do though, so we've got about 20 more slides to get through for day 1. And then I planned on showing you guys or walking you guys through the whole system and possibly looking for a trade setup. So just stay with me, guys. Just stay with me.
Yeah, we like them trade setups.
No doubt. Set and forget, go to sleep, man.
Yes, I was just telling people on my class an hour ago about set it and forget it.
Oh man, it's the way to go. It's the way to go. All right, let's keep going. So let's get into some terminology now, right? Pips. It's a fraction of a penny. It's a point in percent, guys. I've mentioned this in previous slides, right? So you've heard me say the term pips, points, pipettes, lots, thrown all around right now, right? So now we're going to explain what they are and show you how their values are calculated. Because again, guys, it's imperative to understand that all these pips, guys, they don't have the same value. You have to understand that. The value of the pip on UCAD is different from the value of the pip on GBP odd. It's going to be different from the value of USD JPY. Like it's different like that. And if you guys don't understand that, and if you guys don't get that information, you're going to heavily mess up your risk management. So, and this is why I include this stuff into this, right? Because risk management is like, I would say the second biggest part in trading behind psychology. So guys, take your time with this information that I'm about to present to you, because it's kind of required for you to understand. But even though the calculations that I'm going to present to you guys, you all won't manually do, okay? As long as you understand that, hey, the pip value of some trade instruments, they can't just fall under the blanket statement that one standard or one pip is equal to $10 a pip, or one standard is equal to $10 a pip. That's a blanket statement, guys. We can't use that. So the unit of measurement to express the change in value between two currencies is called the pip. If Euro USD moves from $1.10 50 pips to $1.10 51, that 0.0001 United States dollar rise, that's one single pip. A pip is usually the last decimal place of a price quote. Now, I want to point out that, what I'm using in these examples is quoted to 4 decimals. MetaTrader 4, I believe, and TradingView, they'll quote to 5 decimals. So that 5th decimal spot, guys, that's actually called a pipette, and I'll cover that too. Most pairs go out to 4 decimal places, but there are some exceptions like the Japanese yen pairs, and they'll only go out to 2 as well. So again, Euro USD, we're going to use 4 decimal spots, and then on the Japanese yen pairs, we're going to just use 2. Now, there are Forex brokers, as I just mentioned, that quote currency pairs beyond the standard 4 and 2 decimal places to the 5th and 3 decimal places. They're quoting fractional pips called points, right? Going back to US 30, a point, not necessarily a pip, right? Or pipettes. If the concept of a pip isn't already confusing enough for the new Forex trader, guys, just let me make it even more confused for you, that pointing out that a point or a pipette or a fractional pip is equivalent to 1/10 of a pip. So US 30, that point is 1/10 of a pip. And I believe I had mentioned that to you guys earlier that, it's not moving 200 pips, it's moving 200 points, smaller than a pip, right? Here's a cheat sheet for you noobs. All right. So as you can see, this is quoted to 5 decimal spots. And it's telling you the pip count, how many pips or full pips is going on. The 5th decimal spot is the pipette. It's a fraction of a tenth of a pip, right? So it's 0.2. Then you've got the 8, the 4th decimal spot, which is the actual single count pip. The 3 would be your tens of the pip count. The 5 is your hundreds of the pip count. And the 1 is your thousands of the pip count. And you all see how that goes. Take a screenshot of that. Take a picture. Get out of there.
Get out of there.
I
You gotta
know.
be talking to your cat.
Trying to eat all my snacks, man. Listen. Now, how do we calculate the value of a pip, guys?
Back one,
Right?
so I can take a screenshot of that.
Oh, go back.
Yeah, I need a screenshot.
Yeah. Ooh, hot.
All right, we're cooking with Crisco.
Cool. Now, how do you calculate the value of a pip, guys, right? It's just a little math. It's no biggie. This is actually something that the brokers and the trade software does automatically for you. I just like to cover it because, again, it's necessary to understand that, guys, all these pips aren't valued the same. You'll mess up your risk management with that blanket statement. As each currency has its own relative value, guys, it's necessary to calculate the value of a pip for that particular currency pair. This is usually done automatically by your broker. So in the following examples, though, we're going to use 4 decimal spots, right? For the purpose of better explaining the calculations, the exchange rates are going to be expressed as ratios. So for example, Euro USD at $1.25, that means for 1 euro, it costs you $1.25 in the United States dollar. So we're going to write that as 1 euro / 125 euro USD. Example 1, United States CAD is at $1.02. Okay, that means $1.02, no pips. That's to be read as 1 United States dollar to $1.02 CAD, or 1 United States dollar is equal to $1.02 of a Canadian dollar. Now, how do we calculate the value of a pip in this, right? Here's the calculation right here. You take the value change in the counter currency. So let's say for a 1 pip move in CAD, right? You have to multiply that by the exchange rate ratio. That's going to give you the pip value in terms of the base currency. So you take 1 pip move, 0.001 Canadian dollar, multiply that by the exchange rate of 1 United States dollar is equal to $1.02. Okay, so the math below that is done out for you. That equation is solved at 0.0000980 United States dollar per unit traded. So that 0.00009804, that's the value of 1 pip. Now, in order to get the proper value, you have to also multiply that by your lot size. In this example, we're using the mini lot size, 0.10. So if we're using 0.10, we're trading 10,000 units of the United States CAD, right? Then a one pip change in the exchange rate would be approximately 98 cents. So for every 1 pip, you'll get paid 98 cents. You multiply that 10,000 units by the 0.00009804, and that's how you get 98 cents for the pip value, guys. And also we say approximately because as the exchange rate changes, so does the value of each pip move. I got another example. We'll use JPY. Notice that this currency pair only goes to 2 decimal places to measure a 1 pip change in value. Most have 4. In this case, a 1 pip move will be 0.01 JPY, the last decimal spot. It's the same type of equation, guys, as the US CAD, right? You take the 1 pip move in JPY, multiply that by the exchange rate of 123, and then you'll get 0.0000813 British pound. You have to take that answer and multiply that by your lot size. Again, we're trading 10,000 units or a mini lot size of 0.10. And so each pip on JPY is going to be approximately 81 cents and 3 pips. All right. To confuse you a little bit more, let me see. Now, what is a lot? Again, I want to cover this in depth for you guys, right? A lot is, again, that units of currency, okay? The standard lot size is 100,000 units. The mini is 10,000. The micro is 100,000. And we don't deal with any brokers that let us trade the nano lot sizes, but believe it or not, there are brokers out there that let you trade 100 units of a currency. Some brokers show quantity and lots, while other brokers show the actual currency units themselves. And as you may already know, the change in a currency value relative to another is measured in pips, which is that very, very small percentage of a unit of currency's value. To take advantage of this minute change, minute change in value, you need to trade large amounts of a particular currency in order to see any significant profit or loss. That's why lot sizes are so important. So hopefully, guys, you understand the difference between the lot, the margin, and leverage. So here's some more examples, guys, going back to the value of a pip, right? This is where I wanted to get to. So let's assume that we're going to use a standard lot size, right? We always say that, you know, hey, 1 standard is equal to $10 per pip. Well, that only stands true, excuse me, for certain trade instruments. The United States JPY is at an exchange rate of $119.80. So using the same equation, a 1 pip move, multiply that by the exchange rate of 119.80, and then you multiply that by your units of currency or your lot size, that gives you $8.34 per pip. That's not $10 per pip, guys, at all. And so just knowing that right there, guess what? Your risk management is off if you're going off of $10 per pip. You probably actually have a little bit more room to work with. You see what I'm saying? Now let's look at the United States dollar Swiss franc. It's at an exchange rate of $1.45 and 55 pips. So that 1 pip move, again, same equation, right? Multiply that by the exchange rate times your lot size. Now that's $6.87 per pip. That's almost that's over a $3 difference, guys. That's going to affect your risk management parameters. So it's important to know this information that I'm delivering to you guys. All right. Now, in cases where the United States dollar is not quoted first, though, the formula is slightly different. So for Euro USD, it's at an exchange rate of $1.19, 30 pips. This equation, you still started out how we did up above with the 1 pip movement, multiply that by the exchange rate, times that by your lot size, and you get your answer. But what you have to do when the United States dollar isn't quoted first, you have to multiply by the exchange rate again. All right. So you have to take that 838 and multiply that by the $1.19 and 30 pips. Oh gosh, my cat, it's crazy. And for what you get is $9.99, 73 pips. But we round that up to $10 a pip. All right. GBP USD, you do the same calculation. You have to, 0.01 pip movement times your exchange rate times your lot size, get your answer, and then multiply that again by the exchange rate. That's going to give you the $9.99, 41 pips. Again, you just round up to $10. So it's important, like I said, guys, you understand that, not all the trade instruments have the same value when it comes to pip, because that is heavily going to affect your risk management.
Can I ask a question?
Yes.
If you go back to the previous slide, I'm having a hard time understanding this concept, because when I trade, like, you see the pip is 1 pip is worth, like in USD JPY, is $8.34. But when I trade 1 pip,
just page big money.
JPY is still like whatever, like if I do a lot size of $1 per pip, I still get $1 per pip. So I'm having a hard time understanding how this works.
Okay, so what's your broker?
Hugo's Way.
Okay, and your base or your home currency is the United States dollar?
Yeah. Mm-hmm.
Okay, cool. So go using this right here.
All right. They get people who's the comments on the Harlem woman.
Oh, yeah.
It's Black Harlem. I don't realize the movers. It's Black.
Yo, you want to make me co-host?
There we go. Sorry about that, guys. So going back to you.
Make me co-host or Caesar.
Yeah, I can do that real quick. Hold on.
And that way we can take care of it, so you don't have to worry about it.
Appreciate that.
Gotcha, homie.
Let me go back real quick. Where you at, Brian? Where are you at, G?
I think it's alphabetical order.
Wait, is it under your name?
You know what? Yeah.
Are you sure?
I'm positive. Look at the video screen. Look at my video. Look right here.
Why is it not showing you, bro? You're not Brian Covington at all.
No, there's another Brian in here.
Yeah, I know.
Raise your hand, Brian.
Yeah, raise your hand, dude. No. That's funny. Hold on real quick. I'm seriously looking for you, bro.
I just raised it.
Brian Dupree right there, but I don't, bro. I'm sitting here looking at participants and your name is not in this thing. I'm about to search you. Ooh.
It's not letting me raise my hand either.
There we go.
That's because Professor Wallace don't like people, though.
Yeah. No, that's just because I'm a ghost.
Let me see here. All right, you're co-host now, bro. I appreciate it.
All right, got you, bro.
Let me see. Go back to my slide. Play. Boom. All right. So going back to you, saying that, what lot size are you using? Are you using a full standard or are you using a mini?
I usually do maybe like a 0.05, or I might do a 0.1.
Okay. So this example right here, for you to get $8.34, you're going to have to use a full standard of 1.000.
Oh, gotcha.
Mm-hmm. So keep in mind that this calculation, this number right here, this 100,000 units, this 100,000, that is actually the correlation of your lot size. So the 100,000 units right here is a standard, or 1.001. In previous examples, we were using 10,000. That's a mini lot size of 0.10. So so you will get $8.34 per pip on average, approximately, once you start using a standard, though.
Okay, so this, while we're like little bitty guys trading, this doesn't apply?
No, it applies. You still have to, you still use this calculation, but understand that your 100,000 right here is more like, what, 5,000 instead of,
50,000.
or 50,000, I'm sorry, yeah, 50,000 instead of 100,000. So that's going to affect your pip value. Your lot size is what controls your pip value, basically.
Oh, okay, so, I don't know, I guess I'm still trying to figure out how would I go about calculating this? I'm still a little confused, but I'll
Yeah,
just keep.
so just understand that the calculations that I'm going over right now, guys, it's not anything that you manually really have to do. The broker and the trade software does it for you. I'm just giving you the information because it's important to know your risk management.
Correct. And if I may give like a secondary saying of it, essentially Professor Wallace in this first day of class, he is giving you guys the inner workings of things, right? You don't necessarily need to know these things, but knowing these things helps you understand and grasp the market better. So that way, when he teaches the strategy, things make sense. So you don't necessarily have to take all of these things as, you know, I must write this down and calculate this per the pip. You don't have to do that. There's calculators, and like Brian says, this is a lazy person skill set. There's calculators for everything. So if you have a certain amount of risk, you can go onto a calculator, put in your 5-10% risk, whatever you're risking, put in the pair, and it's going to tell you where to put your stop loss. Right. So like I said, he's giving you everything behind the scenes. That way you guys understand everything.
Okay, yeah, I remember that calculator thing. Okay, thank you.
Yeah,
not a problem.
Hold on.
Can I ask a quick question?
Yeah, go ahead.
Okay, so this weekend I was doing Bitcoin. I know I shouldn't have been, but I was messing with Bitcoin. So I would do it in prosperity, right? And I would do like a 0.05 or 0.01. And, you know, it would start me negative, maybe $1.50, $1.20. It wasn't much. But then when I went in Hugo's way and I tried a 0.25 one time and then a 0.05. And I was doing these in demos, so I wasn't messing up my own money. But it was like negative $25 with the 0.25 and then negative like $5 with the 0.5. I'm just wondering how does it calculate with those to make me negative so much?
So when you guys initially open up a trade, you have to really consider the spread, remember? So the spread varies all day. So regardless, if you put, let's say you put, you know, that same 0.25 Bitcoin at 1 o'clock, right? But you want to stack your trade, you're not, and prices at the same spot, but depending on the volume of that instrument at that time, the broker will either widen or narrow that spread amount. And that's going to affect how much you really pay up front to enter that trade. So that's where that difference comes in at.
So it's the volumes that affect it, not really the price point. So it's what's going in at that point.
The spread will affect not necessarily price point.
Okay.
The spread can be affected by different things. Like Wallace was saying, time of day, holidays, news, like different things. More volatile times of the market, the spreads, brokers are going to charge more on the spread.
Yep.
That's why I don't trade.
The minute you open a trade, it could automatically be a negative. That's why, is because the spread. You're paying that spread first, right up front.
Yes, sir. Any other questions? Okay. All right, let's keep going. So going back to leverage, guys, here's that double-edged sword that it'll cut you, right? So you're probably wondering how small investors like us, right, can trade such large amounts of money. Think of your bank who basically fronts you 100K to buy currencies. All the bank asks is that you give them $1,000 as a good faith deposit or margin, which it will hold for you, but not necessarily keep. Okay. Now, the amount of leverage you use, that depends on you personally and your broker. Guys, these brokers out there, some of them offer crazy amounts of leverage. I think the highest I've seen so far is like 3,500. It's crazy. Could you imagine 3,500 to one leverage? Like, bro, you could take $10 and if you knew how to trade, flip the hell out of it. So again, the amount of leverage you use is a personal choice, guys, and also it depends on your broker as well and whatever you feel comfortable with. Typically, the broker will require a deposit or something that's called margin to open your trades. And once you have deposited your money, you will then be able to trade. Your broker will also specify how much margin is required per lot size traded. So the margin here, we're going in depth again on it, right? So your lot size determines how much margin is required to open up a trade. Now, the leverage multiplies your account equity, so that way you don't have to put up so much capital in order to place a trade, if that makes sense. Just to give you guys some more differentiation between the three. So for example, if the allowed leverage is 100 to 1, or a 1% of the position is required, and you wanted to trade a position worth $100,000, but you only have $5,000 in your account, that's no problem, guys, as your broker will set aside $1,000 as your margin and let you borrow the rest. Of course, any losses or gains will be deducted or added to the remaining cash of your account. And then the minimum security or the margin for each lot, of course, again, varies from broker to broker. Understand, guys, that $1,000, it's not a fee. It's a good faith deposit. You get it back when you close your trade. The reason why the broker requires that is that while the trade is open, there's always risk that you could lose money on the position. So how do we calculate the profit and the loss of these pips and things of the sort, right? More math, right? No, but this is something that, again, it's all calculated by your brokers. It's just something I like to touch on and give you guys, because I feel the more versed you guys are with just understanding Forex, the better trading you guys will do, whether you guys use my strategy or whoever's, right? You'll just feel confident because you understand. Okay, so let's buy United States dollar and sell Swiss francs. The rate we're quoted is 145.25, 145.30. That's our bid and ask price. So because we are buying United States dollars, we'll be working on the ask price of $1.4530 pips. That's the rate at which traders are prepared to sell. Okay, so if we were to buy 100,000 units, or if we were to place a lot size of 1.00 at 145.30, a few hours later, the price moves up to 145.50 and we decide to close our trade. Guess what? That new quote for the United States Swiss franc is 145.50. And since we initially bought to open that trade, to close it, we just have to simple close. But again, we're simultaneously buying and selling, right? We have to sell in order to close that trade. So that way you have to take that bid price of the 145.50. I know it's kind of worded confusing, but there's math at the bottom. The price, that's the price that traders are prepared to buy at. So we bought at 145.30. We locked in our rate at 145.30. It went up 20 pips to 145.50. Those 20 pips is our gain. So what we do is we take the value of a pip, right? Now the value of a pip, this is where that calculation comes in handy. We caught 20 pips. How much are those pips worth? Well, one pip, there's a calculation again. One pip's worth $6.87. That's a long way, guys, from $10 a pip. I'd be mad as hell if I was expected to win, $200, but only ended up with 137. I'd be kind of shitty. So this is, again, why it's important to understand that, not all these pips are valued the same, guys. Okay.
I don't like how I felt when you wouldn't make that call because it was outside my trade plan. And you made me not like, yeah.
Hey, you still talking about that?
Yeah.
You ain't gonna let it go.
We know each other for years. I didn't let that go.
That's hilarious. No,
It was
there's
Friday. I wasn't doing nothing.
He's like, please tell me.
He's like, tell me.
I pointed it out. All you had to do was tell me, my G.
He's like, just tell me. My trade plan will allow me to do it.
He's like, nope.
Yes, have that discipline, C's. Have that discipline.
Right. Hey, so someone had a question. It was a good question.
Yeah.
Was Aryeh? I'm sorry, bro.
Aryeh, yeah.
Mr. Israel. He said, does the take profit hit on the bid or the ask?
Depends on the trade, if you're buying or selling.
It's the opposing one.
Right, it's the opposing one. So if you're buying, you're asking, right? It's going to close at the bid. And if you're selling, you're bidding and it's going to close at the ask.
Yep.
So I'm
Or
already,
your take profit could get smashed too by the whatever.
there you go.
Anyway, so.
Yeah, normally, I mean, if you have a good
I
broker,
mean, if
it's
your
like,
stop loss.
it's a difference of like less than a pip normally if you have a good broker.
Yeah. Like the spreads usually aren't too terrible, guys.
Besides, my bad, I know a lot of new people are. Besides when there's like volatile news events, the election,
Right.
that's when you'll see
the spread
opening of spreads.
Mm-hmm.
Certain pairs might have a big crazy spread.
Like what was that? Was it the dude, I swear, was it USD Mexican peso that you guys showed me?
Peso. Yep, peso.
That thing had a silly little thing. Yeah, that's right. I'm gonna have to take a look at that actually. That's
But
pretty
it's calculated different. So I mean, it's still up there, but it's calculated different.
And that's another reason why we go through these calculations, guys. Because even though it may look like a wide margin, if it's not really valued like that, that wide margin may not really be that much. All right, so let's keep going. The trade sessions. We've already covered, guys, what Forex is. We've covered who plays in the industry. We've covered how to trade in the industry. Now we are going to cover when are the best times to trade. I'm pretty sure some people may have already heard this with Brian's calls, maybe even Caesar's calls. I'm going to cover it again because it's important to know. If you guys know, like going back to what Caesar was saying, it was outside of his trade plan, right? I think I called that trade on a Sunday. Maybe it might have been a Sunday or Monday, but
no. This was the one that I saw, and I was begging you to tell me to take it because it's a Friday and I don't trade Fridays.
Yeah,
So
I was gonna say it was
you
Friday.
see that ABC correction to my zone, and you're like, nope, no, I don't see it.
That's what it was.
Never forget that.
Exactly right.
He was trying to entice you to call it.
Hell yeah. Trying to, but he's got that discipline, and kudos to him for having that discipline because it's gotten him pretty far, right? But going back to that though,
6 years.
Hell yeah, there's specific times or better times to trade and speculate in the market, guys, so that way you're not just killing yourself trying to look for a setup when the market's not even moving, right? The strategies that I'm teaching you guys actually has a timing element behind it as well. I only look at the charts a couple times at specific times in a day, guys. I'm not chart watching all damn day. Like that's tiring and it's going to get your emotions caught up in the markets. So yes, it is true that the Forex market is open 24/7 or 24/5 or whatever you want to say. That doesn't necessarily mean it's always active the entire day. You can make trading when the market is moves up. You can make money when the market moves down. But if it's moving sideways or very slow, you're going to have a very, very difficult time trying to, catch some pips. And believe us, there will be times when the market is as still as the victims of Medusa. All right, it's just not really moving. And honestly, with the holidays of Christmas and New Year's coming, you can probably expect as it gets closer to Christmas that the markets really won't move that much, guys. And the reason is you have to think from a institutional or a business kind of mindset. Just think about it, guys. These people aren't at work around the holidays. They have the luxury of trading from usually wherever they are, or if they're a hedge funds manager, they already have off, right? They're not. This part of the year, guys, is a lot of, or I'm not gonna say a lot, it's slower than average because of the holidays. And a lot of the institutional traders, they're just not there right now, okay? So the Forex market hours. Before looking at the best times to trade, guys, we're going to cover what a 24-hour day in Forex world looks like. The Forex market can be broken up into 4 major trading sessions. That's Sydney, Tokyo, London, and then of course, Trump's favorite time to tweet, the New York session. Historically, though, the Forex market has 3 peak trading sessions. That's Asian, London, and New York. This is known as the Forex 3-session system. Some people say Asian, European, North American sessions. Some of them say Tokyo, London, New York sessions. Guys are all the same. It's just a trader's preference, basically. Now, the summer hours for the market, starting on Sunday, guys, it opens at 5 p.m. The Sydney does. It begins with the Sydney session, 5 p.m. Sundays, right? Then Tokyo opens at then Tokyo opens at 8 p.m. Notice though that when Tokyo opens, Sydney is still open, guys. That's key. All right. London opens at 3 a.m. and then New York opens at 8 a.m. London and New York overlaps a little bit. That's also key. And in the intermediate portion, I actually cover the timing element because this is giving you the time when the sessions open, but it's not necessarily giving you the time when the equity houses open and begin to trade. And that's what's important. The winter hours, of course, Sunday, 3 p.m. Well, not really 3 p.m. 6 p.m. That's off. That's heavily off. I'm not going to cover the winter hours. I got to correct that. Now, trade session overlaps. Though these are the areas where I told you to pay attention, like the Sydney and Tokyo overlap, London and New York overlap. Take notice though that in between each Forex trading session, there's a period of time where two sessions are open at the same time. For example, during the summer, in between 3 and 4 a.m., the Tokyo session and London session overlap. During summer and during both the summer and winter from 8 a.m. to 12 p.m., the London and New York sessions overlap. Naturally, guys, these are the busiest times to trade during the trading day because there's more volume when two markets are open at the same time. This makes sense because during those times, all the market participants they're willing and dealing with each other. And this means that more money is being transferred and being dealt with, right? Now, the chart to the right shows you all the major currency pairs. All right, you've got the Euro, USD, GBP, USD, United States yen, Australian dollar, United States dollar, and so forth, right? The numbers underneath those are giving you the average pip movement based on the currency pair and the trade session it's within. So for Tokyo, the Euro moves on average about 76 pips. But in London, it moves 114. That's significantly significant increase from 76. In New York, it drops down just a little bit to 92. So I'm not going to go through all those numbers, but as you can see, London tends to have the most movement out of the three major trade sessions, followed by New York and then Tokyo. Okay. Now the system that I teach you guys, all right, it is a set and forget system. I look for my trades, guys, in between usually 10 o'clock or 10:30 and about 12 or 12:30. If I'm not in the market by then, I haven't seen a setup more times than not. Not only that, I try to enter more times than not off of a pending order. And then I enter in my stop loss and my take profit and I go to sleep. That's what I do for London. When I wake up for the New York session, usually it's about 6 or so in the morning. I'm preparing for the London and New York overlap. So I'm either going to, if my orders haven't hit TP, I'm reevaluating, or I'm adding another position and I'm adjusting some stuff. That's it. I'm going about my day. There's no sense of watching your trade, guys, at all.
Professor Wallace, do you have kill zone times for your sessions?
Kill zone as far as times that I won't look at a trade? Or won't
No, kill zone times as far as there is the highest activity, highest volatility in the markets.
Actually, yes, I do to a certain extent. I just told you, well, I don't have one for London, but I've got one for New York, put it that way.
Okay.
And we'll get into that in the intermediate portion, actually.
Okay.
Of it. Now, what are the best times to trade, guys? Of course, you want to trade when there's multiple sessions open at the same time. Those produce the most pip movements, right? So you've got the Tokyo London overlap. Understand, guys, that Tokyo London overlap is at a weird part of the day. All right, for most of the major currency pairs. All right, so you've got liquidity during the session is pretty thin for a few reasons. There's just typically isn't as much movement during the Asian session. So once afternoon hits for the London people, it's pretty much a snooze fest. I mean, once afternoon hits for the Tokyo people, it's pretty much a snooze fest. Now, with the European traders just starting to get to their offices, trading can be boring as the liquidity dries up. This would be an ideal time to take a chill pill, play some putt-putt golf, look for potential trades for the London and New York sessions. I'd actually do the third, right? And for the Tokyo London overlap, I look for a potential trade setup that I can go to sleep for and let it run all London session. This is the time period where Again, I personally look to set pending orders and go to sleep, set and forget. The London, New York overlap. This is probably the most traded part of the trade day. You've got the two biggest equity houses are basically willing and dealing with each other. According to data from FX Liquidity, that's an analytics service for the Forex market, liquidity is at optimum level around 10 a.m. and 3 p.m. London time. That's actually 10 a.m. Or 7 a.m. to 10 a.m. New York time. That's the kill time for you, my guy. I will not take a trade in New York session after, at the very latest, 11:30. I will not, just because it's just going to be dragging. It's going to take forever. And more times than not, if I haven't entered in by 11:30, I've already missed my setup. So that's when the real shebang begins. You can literally hear traders crack their knuckles during this time because they know they have their work cut out for them. This is the busiest time of day as traders from the two largest financial centers, which is the London Equity House and the New York Equity House, begin duking it out. It's also during this period where we can see some of the big moves, especially when news reports from the United States and Canada are released. New York has the most news releases, just to put it down. And it is, if I had to choose a session to trade as a favorite, I'm gonna choose London every time because it pretty much runs fairly smooth versus New York that has all the news releases. The markets can also be hit by late news coming out of Europe as well. And if any trends were established during the European session, we could see the trend continue as United States traders decide to jump in and establish their positions after reading up what happened up earlier in the day. You should watch out though, guys, at the end of this session, as some European traders may be closing their positions, which could lead to some choppy moves right before lunchtime, right? That's another reason why I say if it's at the latest 11:30, that's my kill time for New York. Now, the best days of the week to trade. As you can see from the chart, guys, it's best to trade during the middle of the week. Going back to Caesar, he trades Tuesday, Wednesday, Thursday. Look at this chart and look at those pip movements. That would be the reason why he trades Tuesday, Wednesday, and Thursday, guys. Fridays are pretty busy until 12 p.m. Eastern Standard Time, and then the market pretty much drops dead until it closes at 5 p.m. This means on Fridays, guys, I try not to really trade past London on Fridays. If I do, I'm out before market close more times than not. And then a weekend starts pretty early, right? Yippee. So based on all of these guys, we've learned from the busiest and best days of the week to trade Forex are, right? The busiest times are usually the best times to trade since high volatility tends to present more trade opportunities. Now, let me break this chart down for you guys and keep it practical. All right, so starting out as new traders, guys, we are only trying to get you guys to consistently collect 20 pips. All right, 20 pips, okay? I told you guys 3 trade sessions that have the most pip movements, okay? And now I'm showing you guys a weekly chart of when these currencies move the most, okay? So if all we're trying to do is catch 20 pips a day and then compound those guys, the system that I'm trying to put together with you guys is going to have you put together this trade plan using all of this information so that way you're just not out here recklessly trading and you have something to stick to. Starting out, like I said, it's 20 pips. Sunday, guys, the euro moves on average 70 pips. All you need is 20. The lowest pip count on here is 19 pips, and that's for euro JPY on a Sunday. If you notice on Monday, Tuesday, Wednesday, Thursday, Friday, that thing's pulling over 100 pips on average every day, along with GBP JPY. All we need, guys, is 20 pips out of those numbers, right? So let's recap. The best times to trade, of course, when 2 sessions are overlapping. Those are the times when major news events come out to potentially spark some volatility and directional movements. Be sure to bookmark the market hours cheat sheet to take note of the opening and closing hours. Also, the European session tends to be the busiest out of the 3. The middle of the week is typically shows the most movement as the pip range widens for most of the major currency pairs. Tuesday, Wednesday, Thursday, London, New York overlap, Asia, Tokyo, London overlap. Okay. Just remember that for the best times to trade. The worst times, Sundays, everyone is sleeping or enjoying their weekend, right? Understand that the market opens at 5 p.m. for us, guys. More times than not, all the liquidity providers that we would trade with are not even open or they're closed after 5, right? So Sundays are typically slow anyways. Don't force it, guys. Scalp it if you are trading on Sundays. Fridays are another bad time to trade because the liquidity dies down during the latter part of the United States session. You can trade Friday London session early morning, like I do. I wouldn't recommend it trading past again 10:30 a.m. for the U.S. session. Holidays, again, everybody's taking a break. We've got New Year's, we've got Christmas Eve and Christmas coming up. Guys, these next couple of weeks, the markets I expect to be fairly slow and choppy. So it's not necessarily you can't trade. I'm not saying that. I'm saying if you are trading, guys, catch your 20 pips, call it a day, get out, right? Scalp it, short term it. Another bad time to trade, which this is kind of ironic, is the major news events. You don't want to get whipsawed. But the reason why I put that right there is because as new traders, guys, you guys don't want to trade the news. Once you guys get some trades under your belt, get a little bit of experience, you'll probably end up trading news. Just because it's exciting, guys. I mean, you can honestly make a lot of money if you do trade the news, but we don't want to train you guys and teach you guys to always chase the news. Okay. And then, of course, another worst time to trade is when you just broke up with your significant other because you chose trading Forex over him or her. Just wait for the next London session instead. That last one is real big, and it's something that I'm actually going to touch on tomorrow when we do the psychology behind everything. Okay, so why do we want to trade Forex? Why does everybody want to trade Forex? There's no commissions. Well, there's small commissions on some brokers. There's no fixed lot size. It's got low transaction costs, and it's a 24-hour market. Okay, not only that, no one entity can really corner the market. Though I will warn you, there can be market manipulation. And of course, we all know that as JP Morgan and all these other people have been hit with fines for market manipulation before in the past, right? Also, the leverage is attractive to investors and also has deep liquidity. And there's also very, very low barriers to entry, unlike stocks. All right. So that is it, guys, for day 1. All right, congratulations, you survived. It was a lot of information. It was probably boring, but it's a great foundation to build upon, guys. I kid you not. All right. So what I want to do right now is I'm going to just briefly, scroll through some of this stuff to show you guys what you have to look forward to, and then we'll take a look at the charts and I'll answer any kind of questions you guys got. So, but like I said, tomorrow, guys, we'll get into like the psychology of trading, which I cover the emotions. Then we'll cover like some of the price charts, introduce you to the price and the candlesticks. And tomorrow I actually help you guys set up the actual template of the Sherpa and stuff like that. Okay. And then we get into the risk management. And the risk management, I give you guys a calculation and all kinds of stuff, right? And then this gets us into fundamental analysis on Thursday, covers like the news releases, what they mean, how to read it, and things of the sort. And then finally, coming up on Friday, this is the good stuff. This is when we get into, the technical side of everything. Okay, guys, we're going to cover different types of candles, a moving average, different type of indicator, Fibonacci, just all kinds of good stuff, guys, that I've got coming for you later here in the week. But I've got to build this upon a solid foundation in order for you guys to have longevity in this whole thing. So we've got a crap ton of information to still get in, and it's in depth. And like I said, guys, this beginner portion is solid enough to get you guys consistently making money. There's still 2 more portions after this one. Like I said earlier, it's a 21-day course in all. And I broke it up into 3 sections: beginners, intermediate, and advanced. All of this that you're seeing on your screen is part of the beginners. The intermediate portion is going to come probably mid-February. The advanced portion is probably early to mid-spring. The reason why I'm staggering it out like that is because I don't want to overload you guys with too much material without you understanding the previous stuff first. But yeah, all of this is coming, guys, this week, and that's the Sherpa system, the beginner portion. All right. So are there any questions about anything, or do I need to go over anything for you guys? You can unmute yourself if you need to.
Class will be the same time tomorrow?
Same time tomorrow.
Same link.
Probably a different link, but it'll be posted in the group or emailed out.
Is the PowerPoint presentation going to be posted in
I'm going to debate
Facebook?
on that actually. I'm gonna debate on that for just for like a day, and then I will definitely have an answer for you guys tomorrow, though.
What about the?
Thank you.
No problem. The recording, yeah, you guys will have access to the recording. I'm not just gonna leave you all hanging like that. So yeah, you guys will definitely have access to the recording. But I'm just unsure about the PowerPoint just yet. I probably, knowing what kind of guy I am, I'll probably end up releasing that anyways, just because I'm just like that, guys. I don't like holding information back from people. That's just me.
Well, if you post it, don't forget to correct the overlapping in the winter hours like you mentioned.
There's actually a few different typos I have to still correct. Also, guys, the presentation that you're actually went through tonight, guys, this is actually still my rough draft. It's not even like the final smoothed out stuff that's going on my website and like that, guys. So you'll see some kind of typos and stuff like that in it, and I need your all's help pointing that out too. But any other questions? If not, I'm actually going to walk you guys through the whole system on the charts, so that way you can see step by step what I do.
I was just gonna ask where we get that market hour cheat sheet that was mentioned in one of those last slides. And thank you so much for your time tonight. This was awesome.
You're very welcome. It's actually here in the PowerPoint. You know what? I'll end up posting the PowerPoint, guys. It's no biggie.
What is she looking for, Wally?
The market hours cheat sheet.
Like the London sessions and all that?
Yeah.
I have a DX one that I can I have a DX one.
The units, actually.
Yeah, I have a DX one that has like the 24-hour time clock, and then it shows all of the times that each session is open.
Okay, bet. Well, if that doesn't work for, I'll give her mine too. It's no biggie. So you're covered either way. We'll get something out there to you guys. All right, let's see.
You're done sharing your screen, right?
Yeah, I'm done sharing the screen. I was about to hop on the charts whenever you get done. See if we can
Okay, I'm gonna show really quick.
Oh, snap, Wally, about to call some trades?
I'm about to try to look for a trade, bro. You know what I'm saying? Walking through the system.
See, it's the only time I can trade outside my trade plan.
Yo, Wallace, don't tell him anything.
Right.
I'm just waiting for this to open up. It's inside my actual my presentation. But
Brian, mute yourself unless you're talking.
Oh, hold on. I'll turn my speaker on the phone off.
I got Ryan on this.
Sorry.
That's so.
Sorry about that, guys. Got Papa Light Skin on the phone. Come on, open up, open up. Ooh, Papa Light Skin on the phone. Come on, it's not opening. Come on, there we go. What's up, Papa Light Skin?
Are there any pairs that you guys want me to look at?
Nas 100.
I knew that was coming. Nas 100 and X. Okay, so XRP, Nas 100, and
oh, sorry.
Okay, cool.
I can't get it to come up, but I could send it to you, Wallace, if you want. It's one that has them kind of laid out on a DX slide.
Okay.
Hey, Wallace.
What's going on?
Pull up AU, bro, because I know Ryan's trading it.
Oh, AU.
Izzy, let me ask him real quick.
Ooh, I got that thing going short.
Which one was it? AU?
AU. He's trading it. Ryan's trading it.
Yeah, you know Ryan's trading it.
Matter of fact, the last webinar that I think we were on last week, Brian and C's, I told you guys I was trying to go short AU and NU, I think, right? I think it was on Caesar's webinar, matter of fact. So yeah, I got that going short. But let me pull these up real quick. GBP, USD. We'll start there. We'll look at a couple of different ones. Damn, man. I wish I didn't have this marked up already. Forget about it. I'll just restart. All right. So the system, guys, that I have for you all. Oh, Brian, are you still sharing your screen? Oh, no, he's not. There we go. All right. So the system that I've got for you guys is a triple screen system. Okay. So what the triple screen means is we take 3 time frames, and the time frames, they actually correlate with one another to a certain extent. And we add in a few price action methods that pretty much help us speculate. So what you see before you, I've got my 3 charts and these 3 time frames right here. I'm not necessarily going to use them, okay? As you all see on my far right chart, I've got a 50 EMA moving average and a MACD indicator. On my middle and my left chart, I've got the same 50 moving average, but instead of the MACD, I've got an RSI. There's a reason for that, guys. The system that I've designed and put together for you guys, it basically tells you what to do. So my first chart on the far right, that is what is called my structure chart. On this time frame or on this chart, I'm basically looking to gather, to see what the trend is. I'm looking to see, most recent breaks of structure. I'm looking to see momentum. I'm trying to gather all of that so that way I can trade in alignment with the higher time frame, right? Now, as you all can see, it's set on the daily. My first chart is always going to be either the 1 hour, the 4 hour, or the daily time frame. And depending on what chart that is, the system tells you what to use, what time frame to use for the middle and what time frame to use for your left chart. So my right chart's my structure chart. My middle chart is my entry setup chart. My left chart is my price action entry chart. And these are all 3 different time frames, okay? So what I'm going to do is pretty much mark up GU for you guys. But before I do that, I do want to notate that, yeah, I've got it split up into 3 time frames like this. Guys, you do not have to do that, okay? Does it help? Yes. But do you have to do that? No. You can just simply switch in between the time frames if you know which ones to use. I give you all of that. So starting out, guys, fresh chart, nothing is on here, right? Just a moving average and my MACD. There's no drawing tools, there's no key levels, there's no none of that. So every time I'm in a fresh chart, I'm marking up my key levels. These key levels, guys, are extremely strong support and resistance lines or levels, but they're not based off, I guess, price action over here on the charts. They're based off psychological price levels from institutions based on a theory called the quarters theory, which is something I get into in the intermediate portion again. So I'm not going to dive too deep into all the whole concepts tonight, guys, because I don't want to confuse you or anything like that. So I'm just going to mark it up. All right. So since this is GU, the average monthly movement for most pairs is about 1,000 pips. So what I have to do is create 3 1,000 pip ranges on this chart, right? So starting out, I want to use this low over here and use this low right here, right? But I'm paying attention to the price. My lines, guys, they come from, my key levels, I should say, come from very strong whole round numbers. because you have to think, guys, we're trading with in alignment with institutions, right? These institutions, they're not going to say, hey, let's take profit at $1.15, 237 pips or some shit like that, right? No, more times than not, they're using nice, clean, round, whole numbers. All right. So we'll see how this goes, right? So my first line, and this goes back to the template that I'll have set up with you guys, is this white dotted or hashed line. It's a strong key level based off the price of $1.10 even. All right. So since I've got that as my first reference line, all I have to do, guys, is add 1,000 pips or 10 cents to my $1.10. So 1,000 pips above $1.10 is actually $1.20. And if you guys notice, I'm using whole round numbers. All right, so 1,000 pips above $1.20 is $1.30. And this is something that guys, once you have these levels on your chart, you don't really have to move them again until, or draw them again until price is in a zone that doesn't have a ceiling or a floor, basically. And like I said, guys, this is nothing new. Everything I'm teaching you guys is nothing new. Now, here's my three 1,000 pip zones right here. Okay. What I want you all to pay attention to is how price reacted to these lines. And notice that I wasn't even looking necessarily at the chart when I made these levels. I was using price itself and the quarters theory. So as you can see, support right here, breakthrough, support, breakthrough, resistance, resistance, breakthrough. Now it's going to be some type of support more than likely. That's all I do right there, right? And then I take those and I cut them in half and create a midpoint. And again, these are at nice whole numbers. So halfway in between 130 and 140 is 135. I cut all three zones in half. And again, I want you guys to pay attention to the candles and how they're interacting or reacted to those price levels. Boom. So that's all I did, guys. Those are my key levels. The reason why I do these is because these levels are super strong. They're great areas to take trades off of, and they generate a lot of pips because, again, we're on the monthly, right? We're not even on the daily. So that's all I do on the monthly chart. Once I've got those guys marked up, now I'm trying to identify my structure chart, which is my first chart. I have to take a look at the daily, the 4-hour, and the 1-hour time frames. So we're going to begin with the daily. What I want you to pay attention to is, again, we're going off of structure, right? We're going off a higher time frame and major structure. This red dotted line, that is a key level. That's a midpoint. As you can see right here, it pinned right here, pinned right here. Now it's pushing away, right? That's something that we want to pay attention to here on the daily time frame. Now what I'm looking for my first time frame is I'm trying to gather or look for a trade that I can take sooner than later. So that's why I look at the daily, the 4-hour, and the 1-hour time frame, because that's going to change every time I look at a chart, basically. So I'm taking note of where the momentum is in the last few days on the daily. Where's the momentum been at, right? It's been bearish. Okay, cool. I'm looking at this move as a whole as well. And I want to mark up any type of break of structure that I see. And my breaks of structure, guys, I define those as with a minimum of 3 candles. This is something that I show you guys later in the week. But for right now, let me see here. So from this high to this low, I'm looking at all of this right here. All right. And since the last has been bearish, what I'm marking up is the highs, all right, or the tops. And notice that I've got everything color coordinated, right? And it's for a reason. So that way, when I go to my lower time frames, I know what type of structure this might be at. Since it's orange, it's on the daily. If I'm on the 1-hour and I see price here at the orange, I know, hey, that's daily structure right there marked up. Color coordinate your all's charting tools, guys. It will help you tremendously. So my most recent break of structure has been bearish, right? This level right here was broken over here. 1, 2, my third candle actually closed back above it. That's fine, but that was just a break of structure. That's what I want to see. Doesn't mean I'm going long or short or anything like that just yet. I'm just marking up a structure right now, guys. And the reason why we're marking up structure is because we want to mark up the most recent break of structure. We want to mark up structure we believe price could potentially reach. And then we want to mark up structure in the opposite direction of our bias where price could potentially reach so we can place our stop loss to save our accounts. All right. And then, of course, you're just going to mark it up or draw it up however you seem fit, right? If you see a trend, draw that trend line. It's only going to help you. And again, guys, everything I do is color coordinated. So this is all I'm going to do here on the daily chart. It's not a lot of information. It's not a lot of drawing, but I just have references now of areas price could potentially reach, right? So my red line is where I don't expect price to go. I honestly, looking at this as a quote unquote double top formation. So this will be the bearish momentum that's starting the second top, right? So I'm looking for a short type situation. Stop loss will, based on this time frame, stop loss will go up here. Where do I believe price could potentially reach? Is back down here to this orange, or definitely back down here to our monthly key level. Because notice after this break over here, it hasn't been validated or tested as a support just yet. So now I'm gonna go to my 4 hour. I'm just, again, guys, I'm trying to find a time frame that I can take a trade off of. So that way I can place a trade sooner than later, right? Always look at all 3 time frames. 4 hour looks a little bit different than the 1 hour, right? So here we see, you know, price action a little bit clearer, and we see structure breaks a little bit better, and things of the sort. So here, what I do now, I'm gonna pull up my MACD, okay? Since it's a little bit of a sideways move right here. So from this high and low all the way over, right? It's not necessarily went anywhere. It's still within this high and low. So even though it went up here and down here, guys, this is heavy consolidation. Sideways movement, not any clear type of trend direction, right? Medusa, right? I'm being mindful of all this as I'm speculating, basically. So here on my 4 hour time frame, what I'm taking note of, again, I'm marking up anything that I see, guys. Color coordinated, right? I do see a channel break as well, right here. I think I should use that one. All right. So going back to our daily time frame, we was expecting a bearish type of a bearishness, right? Because of the double top and things like that. So now it's all becoming about what's a good area to enter that bearish trade. The 4 hour is not going to be my first chart just yet until I take a look again at the 1 hour. I look at all 3 charts, guys, because these first charts, they are determining what type of trade I'm entering. If I'm going to use the 1 hour, that's going to be a short-term trade for me. If I'm using the 4 hour, that's going to be a swing position for me. If I'm using the daily, that's going to be a position trade for me. So using those time frames, it allows me to know what type of trade I'm entering, which is also going to let me understand what type of risk management parameters I need to set. The daily is going to have a very wide stop loss in comparison to the hour. So the daily stop loss, you're looking at about 50 to 70 pips. The 4 hour, you're probably looking in between 30 and 40 pips on average. And the daily, you're looking at in between 20 and 30 pips on average, right? So a minimum trade for me is a risk reward ratio of 2 to 1. Every trade I take has to be a minimum of 2 to 1. Other than that, it's not worth the risk. You want to double up on every trade, basically. All right. So going back to these charts, right? We see this orange from the daily. We see the purple from the 4 hour. That's all technical art. that helps me know where structure stuff is and what type of structure. This is a trend line. This is a channel, top trend line. Anything in between that is in that channel. Price broke below that. This is a counter trend line right here. Price is bouncing off of that. That's all 4 hours, right? The daily has shown us what? That we were potentially looking for a bearish type of move, right? Cool. So what time frame am I going to use? I'm going to use the 1 hour time frame. So since I'm using the 1 hour time frame to go bearish, crap, hold on, guys. Why did you do that? Oh, man. This guy. Sorry, guys. My dog just pissed in the house. It's crazy. All right. No, go lay down, dude. You're nasty. Oh, man. So the 1 hour is going to be my structured time frame, okay? Since the 1 hour is my structured time frame, I have to reference one time frame above this, all right? Just to make sure that if I'm going to go short, I'm going short in a proper area, okay? So looking at this low to this high, what I'm looking or what I see right now is this current move. From this low to this high, this current move is all that is a retracement to me, okay? Until one of these swing points are broken. Now, since this is a retracement, I'm expecting an ABC retracement. In order for this to properly retrace from this bull, guess what it has to do? It has to also go down. So not only is the daily, is my bias short, the daily showed me a double top that is short. It broke this trend line on the 4 hour, or broke this channel on the 4 hour, closing below the 50 moving average, closing below this monthly key level, closing below this counter trend line, and then this nice 3 candle pattern formation. All that screams bear, right? That doesn't tell me where or when to enter. It just tells me my bias, hey, I'm looking for something short. So since I'm on the 4 hour time frame, guys, I want to see my, well, let me back up. 1 hour time frame is my first chart. This is my intermediate chart, okay? It's not my chart I'm necessarily basing a trade off of, but it's just my intermediate chart. I want to place, or I want to make sure the higher time frame or one time frame above this chart is going in my favor, or is at a position to go in my favor. So since I'm going short, I want to be sure that the higher time frame is at some type of, since this is a high, I want to see this at some type of lower high than this type of situation, right? And sure enough, where are we at? It may be creating a lower high than this. So that's cool. That's what I want to see. 1 hour is my structured time frame. So now it's time for me to mark up stop loss, take profit area, and potential place to basically enter, right? So we've got this short right here. It's kind of finding support upon this daily level right here, right? This daily resistance or daily support. But the momentum is down. We are expecting it to go bearish. So I'm looking at this right here as an ABC type of retracement. All right. Now let's mark up some structure. This is my high. I want my stop loss to go up here somewhere. Where do I think where do I think price could reach? Down here somewhere. So what I'm going to do is fill from this low. Nope. Fill from the high to the low of my move right here. And as I said, I want price to make a higher low, a lower high than this high for me to enter in short. My entry zone, guys, is always in between the 618 and the 886. Well, shoot, where'd it go? And even that's color coordinated. Even that's color coordinated. Boom, boom. No,
This is a sneak peek of what's to come, right? Because you're throwing a whole lot of stuff at us.
Oh yeah, it's still recording. And guys, it may be confusing to you at first, but I promise you it's not really that hard of a system. I break it down for you as the days go on. I'm just trying to explain it to a way that you guys understand. So from this high to this low, I'm expecting a push up still, okay? That's to be expected based off of my understanding of psychology and how the market works, all right? Now, going back to the whole timing element of this stuff, okay? The timing behind it, it's in between the proper time for me to look for my trade setup and enter my position. So all of my parameters, I should say, as far as me speculating is on go mode, basically. It's just all about when and where to enter. Let me delete this real quick. Reference my 4 hour. Back up, back up, back up, back up. All right. So let me show you guys this real quick. So you see this push. Now this retracement came in between 886 and 786. That's the retracement, or what I like to see. Okay. Now let me move it down to here. Oops, hold on. On this move right here, what we're actually catching, guys, is an A, B, C type of move. Because again, until this low or this high is broken, any type of inside return to this trend is just that retracement. So what am I expecting? Something like that. It may come up a little bit deeper, but uh-oh, I should have did that. All right, so my entry is going to come somewhere at this B point, okay? And then my take profit is going to be either the 272 or the 618 extensions. Every time. Stop loss is always going to be at the 1.1. Almost every time, I'm actually probably going to adjust that just slightly a little bit due to some more back testing I recently did on it. But it's usually going to be at the 1.1 for right now, all right? Now, is this a good trade to take? We don't necessarily know just yet until price finds a ceiling in order for us to go. Going back to risk management, guys, you always want to take a trade that's a minimum of 2 to 1. What does 2 to 1 look like? Well, let's show you. So if I'm looking to go short, right? Uh-oh, wrong one. If I'm looking to go short, let's say I go short off this the 318 and I'll take it to the 618. My stop loss isn't going to be all the way up here. I can potentially move that probably to the 618. To give it some more room, I'll move it to the 786. Right here, it says your risk to reward ratio. This is a 2.6 risk to reward ratio. So basically, I'm doubling up my risk. So I'm risking, let's say, what, 50 pips to potentially gain 300. I mean, 250. I'm sorry. No, 150. My math is way off. So I'm risking 50 pips to potentially gain 150. That's that 2 to 1. Well, this is almost 2.5. 2.5 to 1 ratio. That's what we're talking about, guys. If it doesn't look like this, a minimum of 2 to 1, never take the trade because it's not worth that risk. And if it does go in your favor, you can't really recover that. Using 2 to 1 risk to reward ratio, guys, allows you to be around a 50% trader, guys, and still be net profitable. So don't think you have to be perfect. Don't think you have to have a high, I guess, win ratio or win rate. Guys, it's all in the risk management. 2 to 1 minimum, 50% trader, you'll still be net profitable. I kid you not. It's crazy. So, but let's go back to this though. When to enter, where to enter. 1 hour is my structure. Let's look at this from this point of view. 15-minute chart, right? Oh, no. 4 hour, hold on. All right, so the way the time frame correlation works with this, guys, is once I've got my first time frame picked out, it dictates and tells me already what to use as my second chart. Since I'm using the 1 hour, my entry setup comes from the 15-minute, and then my price action entry actually comes from the 5-minute, not the 15. So as you can see, it breaks it down for you guys with a top-down analysis. It takes out, what time frames to necessarily use once you find your first chart. All you're looking for in your first chart is structure that you're going to be trading off of, and you're looking for the trend and the momentum. So that way you can trade in alignment with that. So let's say since we want this to be bearish, right? Since we're going bearish based off of this time frame, the second or the middle chart, guys, it actually has to be trending in the opposite direction for me to take that trade. If I want to go short, I have to see this time frame in some type of bull run or in some type of bull retracement. I want to go short, here's that retracement, right? So again, all I do, guys, is I fib to find that entry. Now it looks like to me that this time frame may be finding resistance at this 382. But just knowing how the market works, I still expect one more strong push up. And that strong push up is going to put me into this zone. And that strong push is actually why I set my pending orders and go to sleep, right? So if I'm expecting one more push up, I may put my pending order right here at the 133, or maybe even the even number 134, right? Go to sleep with my stop loss up here, TP down here. Let's see this real quick. Is that a 2-to-1 risk to reward ratio? Yes, it is. So let's put some numbers to this, guys. This move right here will net you, what is it? 167 pips. Wait, that's no. That's not 100. That's what, 16 pips right there. Based on this move. All we're looking for as beginners, guys, is 20. Right? This is a intraday trade right here. I haven't even said I'm a swing trader, a scalper, or anything like that. I let the system define it. 16 pips. It's more than a 2-to-1. It's worth the risk. Set my pending order up here, take profit down there. Now, let's say if I wanted to market execute and enter manually, right? Let's say price was already up here or already found the ceiling, because honestly, looking at this right here, I don't know why it's dotted. Boom. Looking at this area right here, guys, price hit it, bounced off. Now, if we see these 3 hits right here, it hasn't necessarily broken that top level, right? Here's old structure. Here's a high that was broke through right here, came down, price broke through, and now it's using it as a resistance, right? What do we have over here? You've got a point right here. Every time it hit this bottom pink line, guys, you had it engulfing. 1 engulfing, 2 engulfing, 3rd engulfing. You see this BE? That's a bearish engulfing. The engulfing pattern is one of the patterns that I teach you guys to take trades off of. Am I safe to enter in short? Maybe, but I still expect one more push up. So I'm not going to enter. I'm going to put my pending up here, stop loss up here, and then my TP all the way down here. Let me start that over. Any questions so far? You can unmute yourself.
How you sleep at night with your trades open? I can't do that.
And I'm approaching like my 8th year trading, guys. So I mean, it just comes with, just I guess the experience, really. Once you guys demo and build up confidence in a trade system, things become so much easier. It becomes a lot easier to just walk away from the charts. And to help you guys, put some perspective to it, guys, it's just money. Okay. It's just money. It's not your life. All right. And if it's the last money that you have, you shouldn't necessarily be trading, right? But I get it. I get it. You need to use your money to make some money, right? But just understand that, end of the day, guys, it's just money. And with the proper risk management, hell, I can afford to lose 50 bucks. You know what I'm saying? Like, it's nothing, guys. So it comes down to your risk management and just being confident in your system and just having the discipline to just stick to it, win or lose. I do lose, guys. You're going to lose. You just can't falter in your system. And honestly, I think this thing might try to go short. That's crazy off the 382. And if it does that, it'll hit the 618, but probably lower than that, honestly, based off the daily. But like I said, we're just looking for 20 pips. This trade will probably generate you 20 pips. So for this trade, guys, I got a brain fart. I got a pending sell limit up here at the 618 at 133, 133.25. Stop loss 134, 134.6. My TP is actually going to be a little bit deeper than this. I'm actually going to put it at the 132. And I want to go ahead.
The round numbers.
Yeah.
Versus the micros and the minis and all that other stuff.
Yeah, I'm not. We're trading with the institutions. The institutions aren't using all those pips, man. They're using nice, clean numbers. I assure you. I don't really like to mess with, the 23 pips or the 2 pips and all that stuff. Nah, man, we're going to use nice round hole numbers, because believe it or not, like, if you guys just really look at a chart, it doesn't matter what time frame, look at where a lot of the support and resistances are found in relationship to the price. You'll see that it's usually at some type of nice round hole number. It's pretty crazy. So the move that I'm actually expecting, guys, again, is the A. This is a zigzag B and then another C. You guys will understand the ABC when I do the Elliott wave portion of the training. But again, I got a pending order at the 133. Stop loss is at the 134.6. TP is at 132. And look at this right here, boy. That thing may just drop. That's crazy. If it don't hit my pending, I'm gonna be so angry. I might just market execute. All right, but that's GU. So we didn't get a chance to really use all 3 time frames on GU. But what I can do is just look at it, right? This is the 5-minute, this is the 15-minute. And the reason why I use TradingView is because the powerful drawing tools and how I can do this triple screen properly with it. That thing is already dropping. That's crazy. So actually, GU may not even pop up to the 618, guys. I think I'm gonna probably manually execute an enter on this one. Just a second. All right, cool. So that's GU. AU, we'll take a look at. I probably have it marked up, but I'm gonna clear it off for you guys. Actually, I did clear it off for you guys. That's crazy. So going back to earlier in the webinar, I was last week I had told, I believe, Caesar, that was on his Thursday webinar, I believe it was, that I was potentially looking for AU and NU to go short. And this week, I believe that's probably starting to play out. So let's just take a look at it. I'll blow it up for you guys real quick. So as you all can see, this has already been marked up with my key levels, right? So I don't have to do that just right now. I can just go to my daily. And then as you all can see, this is kind of my current drawing tools. I'm going to delete some of this stuff and then draw it over for you guys, actually. All right. All This isn't relative at the moment. Boom, 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 boom. So only thing that I'm going to leave on here, guys, is of course my orange, because we're on the daily time frame, right? Here's the counter trend line. The retracement broke, still bullish. Now, we have been in a bull run on AU or EU, NU, and things like that of the sort. What I want to point out to you guys is sometimes Caesar and them will reference the daily time frame. I mean, not the daily, the dollar index. This is the dollar index. Now, as we can see, the reason why AU and such has been bullish is because the dollar has been losing value. Now, though, down here at the $90 area is a key level that price may begin to find support at to, retrace up or enter a bull run, just regardless of how long it may enter in bullish for a little bit, right? So since this is the daily, look at this. This could be considered a quote unquote double bottom, but in order for it to be confirmed it's a double bottom, we have to see the bull momentum shift away from it. All right. I can check this with my MACD. So what this is showing me, that the light bars are showing me that the bears have pretty much, are losing their momentum. My moving averages are looking to cross. So this is telling me that this bear run is pretty much coming to an end or looking to come to an end. Since it's the dollar index and the bear run is looking to the end, it may be shifting over to a bull. Our bias for like AU and GU, guys, would seem correct, right? Boom. So we've got this 3 candle pattern formation right here. My breaks of structure, guys, again, require 3 candles. And to go deeper into that, it requires a minimum of 2 of those candles being in the prior trend favor. So if for this to be a proper break of structure at this high point right here, this candle's valid, this second candle's valid, but this third candle has no bullish momentum to it at all. In fact, if I zoom in, it made and closed at a higher low than the previous day. I mean, a lower high than the previous day. Y'all see where this closed and opened at in relationship to the open and close of this? This is a lower high than this. That's something that we cover in the intermediate portion, is price action, because you literally, guys, have to sometimes zoom in to see this stuff. All right. So since that's a lower high, we're seeing the proper momentum already playing out today on the Australian dollar, right? As far as it being short. It just all becomes a matter of when and where to enter that short, because it's not just going to free fall, right? Let me see. So I didn't mark this up just yet. So where do I enter? Where am I looking to take a trade off of? Since this dotted line is already here, I don't have to mark anything up. What I do want to mark up though is right here. Because this high was broken over here. So this is structure that will be tested by a retrace. Okay. So this is where I expect structure or price to reach. This would be like a TP. Okay. Up here is an area where I believe my stop, if price was to reach, it would continue to keep going, right? That'd be a TP. So this is all of my daily right now. I'm going to check out the 4 hour just to see what's going on. We can read price action a little bit better here on the 4 hour than in comparison to the daily, right? Again, guys, you can just draw your trend lines, your channel tools, all of those, guys, they're good to put on your charts. Just make sure they're color coordinated. Let's see, I'm actually going to do right here. Oops. Tough one, tough one. It's not perfect. Nothing's ever perfect, but I'm drawing up my channel that I see, right? Uh-oh. Price did break up above it, but do I expect it to stay above it? No, not just yet. I do expect a retrace, right? I'm expecting it to retrace to this level right here. Well, actually, this level right here first. This is starting to look more of like a scalp type of trade or short-term trade. Let's see. We got some questions in the chat. Hold on. Yeah, Chelsea, I'm going to be doing this all week, guys. We're going to be, doing some training. And then after the training class, we'll be looking for trade setups all week. All right. I lost my train of thought. Oh, I'm going to check out the hour. There's not much for me to mark up on the 4 hour since everything's already pretty much marked up. Let's take a look at the 1 hour. I'm still just trying to look for a structure chart, guys. All right. So here's a good one for us, actually. See this double top from this low to this high? This structure right here was broken over here. It should probably come to retest to it, right? Or retest to this. So what I'm looking for, since we're looking to go short, we're already short right here. I'm going to fib. The 1 hour is probably going to be my structure chart. I can't fib right there just yet because it hasn't been set. Whew, tough. So with the USD, odd USD, guys, I want to go short. There's not a setup for me to go short off of just yet. It's actually already in a short trend. So instead of, chasing or trying to create that setup, guys, you just stand aside, you sit on your hands. So 1 hour time frame is bearish. Let me see what my 15 minutes says real quick. 15 minute is bearish and my 5 minute is bearish. Based on the Sherpa system, I have to sit aside. So in order for me to enter a trade on this right here, a short sell, this has to be bearish, which it is. This has to be bullish in a retrace going up to test the bottom of this structure. Okay. Once it's at that structure, then I could speculate a short trade on it. Oh, geez. So we want price to return up here to test this structure, guys, before I enter in a short sale. AU is still short, but it's just already in its move. That's crazy. Heavily in its move too. So short on AU. Hopefully Ryan was in agreement with the AU short. He might be looking for the retracement back up though, but it's ultimately short for me right now, in my opinion. Let's see. Hey, that's what's up, Ben. I'm glad you learned it, man. Karen, he was short or was he long? Yeah, he was short. Yeah, that's what I was telling you. Yeah, it's a short sale, guys. But with the system, guys, like I said, I have to sit aside right now until I see this middle chart come up and test some type of structure. And that's honestly what I recommend for anybody to do. Because again, it's not just going to free fall to hell, guys. No, it moves in waves. It moves in layers, right? So from this high to this low, there's going to be some type of retracement wherever it creates that low. And honestly, that retracement probably is going to come right before London just to try to entice some people to go long again, right? And then once they do that, they're going to shoot the hell up out of it and go short, kill their account. That's how they work. So wait for on AU, wait for a retracement to happen, right? Probably back to the 753 area and then go short with it.
So what are you thinking? A sell limit order?
Yes, sir. So I can't really do a sell limit just yet until I see the inside retrace, or until I see this low created. It's not created just yet, right? But if it was created, look where this structure is at. It's at my 618, in between, right at my entry zone, the 618 and the 86. That whole zone is where I look to enter at, guys, and place my pending orders. Stop losses up here, safely above this high and this high. That's valid. Let me zoom that in for you, actually. Boom. So let's say we entered in right here. Your take profit with this system, guys, always, always, always defined for you, right? That's a two and a half to 1 risk reward ratio. That's a safe trade to take, right? Risk 17 pips to gain 40. You only need 20, guys, right? Guys, this is the Sherpa system. This is the beginning portion of the Sherpa system. Like it's really not, it's not difficult. Like I said, I've got everything laid out for you guys and I'm gonna release it to you all, but just haven't just yet. Let's see. So yeah, just wait for this retracement to happen. It may not even retrace just yet, but I can't take a trade or enter a trade just yet on AU. If you guys want to, that's your personal choice. Understand that you're going short though. Understand if you do enter it right now, there's no telling when it will retrace or if it will retrace. I just like to see a retracement for the best chance of profitability and to have the best risk to reward ratio, if that makes sense. Just don't force it, guys. You know, sit on your hands, be patient. So that's AU. We did GU and AU. Let's AU short, GU short. Let me look at one more for you guys and I'll let you guys go. What do I really want to look
Hey,
at?
Wallace, would you look at gold?
I can. Let me see.
Thank you. How you doing tonight?
I'm doing well. How
Yes.
are you?
Yes. Good.
She said yes. I know that's right, man. Let's see. Boop.
Even though they keep telling me to leave gold alone.
I know. It's just, it calls your name.
I was like, "Ah."
Hey, sometimes we have our favorite pairs, right? All right, let me boop. Let me boop. Let me boop. All right, cool. All right. So going back again, you know, to the dollar index, guys, right? Gold and the dollar index, I think they're opposites of each other. Whenever the dollar's rising, gold is usually falling. And whenever gold is rising, the dollar's usually falling. So since we're expecting the dollar to, you know, make a rise temporarily or however long, I expect, you know, gold to still be short, right? So this is a perfect example or a prime opportunity to show you the full Sherpa system. All right, so starting on the daily chart, we're gathering momentum, we're gathering a bias, we're looking to see what the previous, you know, 2, 3, 4, 5 days have been doing and in relationship to the current day, right? So looking from this high to this low, guys, here's what I want to point out to you. From this high to this low, it retraced, right? Came to the same situation, retraced, right? Came to the same situation, and it retraced a little bit. The breakthrough. My breakthroughs require a minimum of 3 candles, okay? With 2 of these candles being in the trend's favor. So since it was a bearish break of structure, your first candle, a lot of volume, a lot of momentum, it's a very big candle. Second candle, a lot of volume, very big candle, lots of momentum. My third candle, that's my 3 candle break of structure, letting me know, hey, it's bearish, right? Now we've got this retracement. So from this high to this low, all of this is, guys, is a retracement, right? It retraced right to that structure that it recently broke or that it had broke, right? This is all stuff that you have to pay attention to. Since it came back up here, what are we expected to react the same way that it previously did. Since it broke down heavy right there at this level, when it approached it again, met with my 50 moving average, met with a ceiling, guess what happened? This huge engulfing candle happened. This is a 3 candle pattern formation. Another thing I want to point out to you guys is in the zone that it actually happened within, right? 618 to the 886. That's where that's happened at, guys. That's why this zone is so key. This is why I like to see my retracements go to that deep retracement. So we see this engulfing. Now all of this right here, The price action, guys, of this right here is telling me that we're still on the short side because this candle closed low. This candle made a lower close. This candle closed in a bull, but it made a lower high than up here. After that, guess what? This candle went bearish. This is bearish momentum. So notice though, price did come up here and pin down. That's what we want to see if we're looking to go bear. So this current candle on the daily is going up to test some type of structure, guys, that was broken by these previous days. Now we have to find a time frame that basically shows that, right? So let's take a look at the lower time frame. Let's look at the 4 hours, see what we can see. All right. 4 hour time frame looking kind of silly. Shoulder, head, shoulder. That's a technical pattern. But on the shoulder, head, and shoulders, guys, we only expect it to go back to the neckline. The neckline is down here. Now, what is that? Is this my fib line? Yes, cool, bet. Now, what I'm paying attention to is that all these candles are closing below the 50. Our previous time frame, which was the daily, was saying, hey, go short, right? Cool. Now I'm looking for an area to go short. I see this as a head and shoulders. I see this structure right here, but I'm going off of this. This is the 4 hour, guys. We can go off of a little bit more recent price action, I should say. All right. Starting from this high, we see the break of structure. Minimum of 3 though, right? This one actually took 4. First candle stayed closed beneath it. Second candle, cool. My third candle didn't have any type of bearish momentum with it, so it was a little bit iffy. And then finally, boom, the fourth candle. That's a clean, proper break of structure. Since that was the break of structure, we wanted to come up here and retest it, right? Here's a kind of a retracement. Here's a kind of a retracement that retested to it, right? None of that, it didn't have any bull momentum to it. You've got this engulfing, a lower high than this high. Now you've got this, a lower high than this high. Now you got this. If this is creating a lower high than this high, you're still looking for the short opportunity to ride that bad boy, probably all the way back down to the 1780 area. All right. Now, what I like to do is I'll fib both ways. Since this is a bull trend, and this is from this low to this high, on the major or the macro view of it, all of this is just a retracement. All right. And since we have to identify that as a retracement until it breaks this structure or this structure, we are looking at an ABC correction where, you know, A, B's kind of sideways. And then of course, C may come down here somewhere. We don't really know. This is just speculation. This is what we have to do, right? We have to think of all possible outcomes and scenarios to our trade, guys. So the 4 hour, what I'm going to mark up now is just some structure areas where I think price could reach, what I think price could potentially reach. And of course, I'm going to use this orange line. So this top purple line is where I think price will find or make a lower high than over here, right? Or it might make the same identical high as right here, which would be a corrective double top M. And then hit this C leg down. So I'm not gonna just stop right there though, right? Because that takes a while to play out. Again, I'm still gonna look at the 1 hour because again, I want to take a trade sooner than later, right? This is why we analyze all 3 time frames. We already know that it's looking bearish. It all becomes about what's a good area to enter in off of now. And what I'm seeing is from this high to this low, a lot of sideways consolidation. Now, I do want to do this though. You see this high right here, right? At this wick. I do want to see how price is reacting to it. We've got bullish engulfing, bullish engulfing, bullish engulfing. If I'm looking to go short, guess what? This is what I want to see. Holy crap, I almost got thrown off. Let me change this to the 1 hour real quick. Change this to the daily. And change this to a 15. All right. So these are my 3 time frames, guys. The daily is my structure. Well, actually, yeah, daily. We'll use daily as a structure. We'll say the daily is the structure. 1 hour is the entry setup. The 15 would be my candlestick price action entry. If I'm looking to go short, I want my middle time frame to be bullish. The reason why it's bullish is because it's in a retracement heading back up to some type of structure that was recently broken. We have to identify that. So in order to do that, though, we fib this high to this low. Again, we want price to enter in between the 618 and the 886. Again, let's see if we let's say we enter at with a pending order right there, stop loss up there. We can ride it all the way down here. Again, guys, it's a 2-to-1 minimum risk to reward ratio. That's a good trade to take, right? Now, here's what we're looking at. A, B, C. The ABC correction to this bearish move. That's why we want to see that middle time frame trending in the opposite direction of our bias from our first, because it's usually an ABC type of correction. Boom, let's break this down real quick. Why is it not? Hold on real quick. There we go. I knew something was acting funny. All right. Now I got to redraw this real quick. So this is our entry zone. We're looking at an A, B, C type of correction. Boom. Change that to the daily. Now I'm good to go. All right. Now we're Gucci. So we're looking for this ABC correction to kind of play out, right? For us to go. Nobody's playing piano. All right. So yeah, we're looking to go short from off this ABC correction, right? So going back, if you all have taken Caesar's and Brian's class or Ryan's class even, they always tell you guys the 3 R's, right? You're looking for the rejection, the retest, and so that way you can react, right? You're looking for the retest to have rejection, so that way you can react. So this system works perfectly with that. We're going bearish off the daily time frame, right? Right now, the daily time frame is in a bull run because it's in a ABC Elliott wave correction. That's what we want to see for the best potential to profit from the pip count, right? So now we're looking for this bull run to meet some type of structure up here or a ceiling and find rejection. Once we see that rejection, guys, we're on the 5-minute chart or the 15-minute chart looking for an engulfing type of pattern or a Maribozu type of candle formation over here. Until that happens, I won't necessarily market execute. Also, what I'm seeing here on the 15-minute chart, well, it's not a void because that's not an engulfing, but if it was an engulfing candle, I would say, hey, this was a void that this is actually at right here, and then go from there. But on gold, I would say I'm actually ultimately short, just temporarily, because we've got the dollar gaining some strength temporarily. Does that help you out? Where'd she go? Hey, you out there? Yeah, it's a reversal block, Matt. You're
Oh,
right.
I'm sorry. Were you talking to me?
Oh, whoever wanted me to look at gold.
Oh, that was me.
Oh,
I
yes,
was
ma'am.
listening. I was looking.
Got you.
Awesome. Thank you.
No problem. No problem. No problem. But yeah, so we're probably seeing a nice entry about to play out for gold, guys. Just watch it. Like I said, look for the rejection and wicks and exhaustion. And so what that means is price action. You'll see the wicks towards the high. And once you start to see that, you want to see the red candles have nice, full, big body candles forming. And that's your signal for your entry, basically. Let's see. She holding that's what she does. Ben said he got a wow moment when he was looking at the 3 charts. Yeah, bro, just wait till you get through the whole course, man. You're probably going to have a few more wow moments. I kid you not.
So you're not actually defining yourself as a swing trader, a scalper, or anything like that. It's whatever the charts give you at the moment.
It's the trade setup, bro. You're exactly right.
Do you ever go down to the 5-minute chart or no?
Yep. Only time you can always go down to the 5-minute chart regardless of what time frame you find as your structure chart. But more times than not, I'll only go down to the 5-minute if I'm using the 1 hour as my my structure or my first chart is when I go down to the 5-minute.
How often do you find your structure chart being the 1 hour or 4 hour?
More times in the daily. The reason is because, again, you know, the time it takes to form these candles and these setups, right? The higher the time frame, the longer it takes. So more times than not, guys, you will be, you know, intraday trading or short-term trading, but but when you do see those daily trades, guys, take them and hold those bad boys because those are going to generate a lot of pips. A lot of pips.
Okay, one question.
Yes, ma'am.
When you do your trends, the trend line and like the little channels, I see sometimes you I don't know if it probably wasn't a mistake, but I see you will maybe start with the highest point or lowest point at a wick, and then you'll connect it to a body. That's okay?
When I throw it depends. So let me find the example I did actually, because I know exactly what you're talking about. I think I used the purple line. Was it on odd?
I'm not sure what it was on. It was like
here.
maybe 15 minutes or so back.
Yeah.
Okay, yeah, that works right there.
Yeah. So I try to use the wick to wick more times than not, because the wick is actually an area that price went to. And if you go to a lower time frame and actually look at the wick, you'll see that candles actually closed up there and created that wick on a lower time frame. So on this one though, I actually went from, I kind of used the wick, and then I should have went to this wick, but all I did was just keep dragging it out. Right? Just make it make sense. Dogs. So just make it make sense to you, basically. So from this high to this low is basically, and I always try to use the wicks over the bodies. But there's no right or wrong way. Just make sure you're consistent with it. If you're going to use the wicks, go wick to wick. And if you're going to use the bodies, go body to body.
Okay, thank you.
Very welcome.
What charts are you looking for your confluence? Or are you using multiple chart confluence timeframes?
I just use 3 time frames, guys. And it's the time frame correlation. So, and the 3 charts that I have to define with this system are, again, your structure chart, which is your first chart. You have to figure out where the momentum is, where do you feel it's headed, and if it was to go against you, where would be a good place to put a stop loss. That's your first chart. Your second chart, you're looking for price to be returning to the most recent break of structure from your first chart. And so your second chart should be trending in the opposite direction of your bias from the first chart. I know it's going to be weird at first, guys, but that's what you wanted to do. So if I'm looking for a buy based off of my first chart, I want my second chart to be in a sell in a sell type of trend, because that means from the previous session of all that bull momentum, you're in a retracement. Okay. So in that retracement is going back to retrace the structure that was previously broken from the previous day's trend or whatever. And then once you see price at that structure that needs to be retested and validated as proper structure, you drop down to your third time frame to read the price action. And that's where you're looking for like your reversal candle patterns and your reversals, your engulfing, your Maribozus and things of the sort. And that's the whole system. Actually got a, let me see if I can show it to you guys real quick. I'll give you guys a sneak peek real quick.
So basically, your second chart is your reversal chart, and your third chart is your entry chart.
Yes, sir. Yes, sir. And I've got a cheat sheet, like I said, that I'm going to release to you guys. Is this it?
By the way, I took that GBP USD though. I did a market entry.
Oh, did you? Dope, man. Yeah, I did.
Well,
I still got my pinning set though, because I was expecting another push up, but hey, that's just what it is. Oh, this right here. All right, so this right here, guys, is something that comes on day 4 and 5. This is the system in a whole. Okay, it basically, like I said, your structure chart, entry setup chart, your price action chart, what type of trade you're going to enter. If your structure chart is bullish, or your momentum from your first chart is bullish, and your momentum from the second chart is bullish, guess what? You stand aside. That's what we did. That's what we seen on odd USD, right? We seen the first chart was bearish, the second chart was bearish. So guess what? I stood aside, right? Now, if the first chart on the odd USD was bearish and my second chart was bullish, then I would have went short. Okay. And this is how the system works. If your first chart's bullish, your second chart's looking like a bear trend, you're going to go long on your third. If your first chart's bearish, your second chart's bearish, you're going to stand aside. Like, guys, this is the type of system that I've pretty much designed, and it takes a lot of the guessing. It takes out a lot of the work of trading out of it, because all you do is just follow the system step by step. If this chart's doing this, that chart's doing that, that's the type of trade you're looking to speculate on. Not only that, I've broken it all the way down to what type or what type of position you could potentially even be entering, whether it's a swing or a position trade or a scalp or short-term trade. Like, that's the type of system this is, guys. Like, it's no joke. But the cool part about it is it's not new, I should say. It's not nothing that I will create out of thin air. All I've done, guys, was taken all the knowledge that I've acquired over the years, meshed it into one strategy, and teaching it in a way to where I teach you guys and show you guys how and when to use different concepts that you're learning already anyways. And that's the whole Sherpa system. It's pretty dope, honestly. And then let's see, the last day, you guys get this cheat sheet right here. And this cheat sheet basically breaks down again your 3 time frames, right? And it puts the Elliott wave system behind it as well. But we won't touch on that just yet. But yeah, man, it's a lot of good stuff coming, guys. It's a lot of good stuff coming. Let's see. I appreciate that, Jay Bird. Appreciate that. Are there any other questions before I let you guys get off of here? I think I've kept you guys 3 hours. I didn't really want to go that long, but hey, it's all good. Hey, you're very welcome. Very welcome. Yes, Sherpa is, it's a good system. And like I said, the beginner portion, guys, is solid enough to get you guys trading consistently and earning some nice profits. So, but we're back again tomorrow, guys, 9 p.m. Eastern Standard Time. We'll do another hour session of learning, and then we'll take a look at some charts. And like I said, guys, with it being around Christmas, the markets, they're not really too actionable around this time of the year, though, but we'll try to find something.